Welcome to the Learning Crypto Investing course. It's about 3 hours, maybe a bit longer. There is a load of chapters at the bottom for you to skip through. And it has been firstly recorded in 2022. It's been updated in 2023 and 2024. It's been all put together from our platform, okay? Free to use now for you to get involved. This is the first part of your journey, potentially, if you've come across this, investing. The next course is technical analysis. The last course will be psychology. These will be released. Please do subscribe to the channel if you've not yet done so. We do a lot of videos weekly anyways, and a lot of evergreen stuff and more up-to-date stuff. But we thought, let's put our courses on YouTube to give people something of much bigger substance so you can learn and you can have it ready available. So yeah, skip through, have some fun and enjoy. Please do comment what you think. And let us know if you have any questions as well in the comments. It will make a big difference to the video algorithm. And yeah. Before we get into the course content, we have to do a little bit of an arse covering session with some legal stuff because you have to be responsible. So as a disclaimer, as you can imagine, we are not financial advisors. This content is for educational purposes only. And most importantly, anything that we recommend or utilize or use in terms of like on the screen is not really a recommendation. We're just using it as an example, you know, to illustrate certain things that may have happened or may not have happened in the market. They are not recommendations. Cryptocurrency and also the stock market is very risky. You could lose all of your capital if you're not careful. And finally, you are fully responsible for your own actions. Only you, not me, not Gaz, not anyone else within the community that you may have found yourself in with learning crypto. You are the one that does the buy-in. You are the one that does the selling. It's all down to you to learn. This is what this course is for. So your money position, it is an important factor. You probably don't think about this, but it is. I often talk about this because it's hugely important. As an educator, or whatever you want to know me as, I often get direct messages and it's one extreme to the other. Sometimes it's, I've got X amount of money, I've just sold a house, I've got equity out, whatever, I want to invest in crypto, usually when the times are high. And then you got the opposite is, I don't have much money, how do I make money in investing? You need to have money to make money. It's kind of the biggest factor of investing, right? The compounding effect, we'll go through that throughout the course. But the fundamentals are clear. You need to have money, right? And let me explain, because I think the basics are massively overlooked in certain aspects, right? So for me, can you afford to invest, right? Can you actually go, right, I have got money to invest? Some people don't. And we are currently 2023, 2022 sort of period has been pretty bad. And what's happening? Well, the cost of living has gone up severely. A lot of things have changed massively. So we've got to look at that as a factor. Another factor is, do you have enough funds as an emergency? Do you have money stored away just in case something, you know, blows up in your house? For example, a boiler. What about if your car breaks? What if emergency medical care is required? Certainly if you're not in the UK, that's a big factor too. All that kind of stuff will make a big difference on your life if you don't have it. You've got to have that first, right? The other thing is, do you have a regular income? A lot of people came to learning crypto in the past due to coronavirus, due to the furlough scheme in the UK and obviously around the world not working. You know, regular income is great, but learning a new skill is also great. But the problem with learning a skill like investing, there's no point learning it if you can't invest, right? Essentially, you've got to have the money to also be able to follow through. It's not like learning how to knit or something like that. You've actually got to, you know, act upon what you're learning too. Another obvious is, do you have a goal in mind for retirement? Now, a lot of people do come to learning crypto or, you know, my YouTube channel and want to like essentially understand the purpose of money, being able to invest better, understand the trends and stuff like that. You know, if this is a vehicle to make you retire quicker, brilliant, fantastic. However, you've got to have a goal in mind. And then following on from that is kind of obvious. Do you have a plan to achieve those goals? What is your plan? Do you want to buy just into crypto? Do you want to do it into the financial markets too? Are you looking for other ways to distribute wealth? There's all kinds of stuff, but having a plan makes life so much easier. But always have that plan. Always stick to it. Always use it. And always risk what you can only afford to lose, right? Literally with cryptocurrency, not to be really doom and gloom, there's certain ones that do go to zero. It's happened before. If you go too deep in a certain asset, you will lose all your money if things get exploited and if things go very, very bad. So what is investing? You probably know what it is. I know you probably got some knowledge of it, but there's some things you probably not be aware of. It's certainly if you're brand new, certainly what you can do, the different types of markets and stuff like that, okay? So we'll keep it super simple, and it's important to note a few of these. So essentially investing is about putting money away or into something for a long period of time to enable it to work. Put your pennies to work, as they would say. This could be a project, a share, a property. It could be all kinds of elements that could be utilized to generate positive returns. That is the ultimate game. Whether to live off it, whether to, just get appreciation, many different factors, okay? Investing is also very, very different from saving, as you could lose capital and obviously projects could fail. A lot of people look at savings and don't risk. Everyone has a different risk appetite. Some people will put loads of money in the bank and not do anything with it, but ultimately inflation is kind of killing you. In my opinion, you've got to make your money work, whether you are putting in certain vehicles, which we will talk about very, very soon. You have different types of risk, as I just kind of alluded to. People will save, no risk appetite at all. But there's different types of investing that has different risk appetites to enable you to do better. So whether that is into a pension fund, an ISA fund, or stock shares, whatever they may be, right? You can do this yourself, or you can employ the services of a professional money manager. There's a lot of things like robo-investing. There's like stocks and shares ISAs, which have big funds, which some like companies will move the money around for you, or you can go and seek a professional advisor and they will manage your money for you with fees attached to them, obviously. Most common investments are the likes of stocks and shares, bonds, index funds, whether they're like the S&P 500, the NASDAQ, real estate, property, etc., collection art, so art, collection cars, etc., and obviously cryptocurrency. So going on to returns, I've already mentioned it, but you could make losses on any investment. You could also use these as a tax loss for any future potential gains. So for example, if you made a loss in one financial year, you can utilize those capital gains or that loss of capital gains and utilize it for when you do actually make some gains, which is quite useful. The simple returns that you can have on any asset, mainly using this as an example here. So obviously buy one share of whatever stock you've got at $310 and sold it 6 months later for $462 or $460.20, sorry. Your return would be 48%. If you're utilizing like a load of different portfolio management, or if you're utilizing like a trading view, you can be able to calculate this very, very easily. Throughout this course, we will go through how to manage your money, how to manage it yourself, essentially, so you can see what your returns are. Because ultimately, if your maths isn't your strong point like myself, it makes sense. Some investments have dividends. This is important to note. This could also throw out certain elements of, returns and the cycle returns and stuff like that over a course of time. And the most important thing, some returns can be more complex. Certainly with property, there may be further taxes to take on board instead of capital gains tax, such as stamp duty and other bits and pieces that you may have forgotten about. So make sure you do those calculations first. What is a bull market? Now, this is where things start to ramp up a little bit, but ultimately pretty straightforward in the eyes of how markets work. In simple terms, it is when prices are rising and expected to rise further. This term can be applied to any investment. So a bullish period for anything, whether that is in the stock market, whether that is in crypto, property, is because prices are much higher than they were. These are determined by higher highs and ultimately higher lows in an upward bullish trend. So if you're looking at trends, if you're looking at how oscillator data goes up, you'll see that prices have gone from say $1 up to say $10 in a period of 7 years. That is a bull market. Often leads to new people coming into the market. and making the prices go even higher due to the emotional hype generated. Feel free to pause this and just, put your hand up if this was you, because a vast amount of people come into these financial markets in a bull market, usually. And it's often where the most hurt is. I often say this, that bulls will get you destroyed, but bears will keep you hungry, right? It's just the way it is. It's just because if you buy at the wrong time on hype, you're going to get some realized losses very, very quickly. And sometimes in a bull market, when the market does pull back, it's quite aggressive. And if you're new, you're going to sell, and it's not good. And it will continue going higher. It's not nice. We've also seen in the past that big fund managers can over-risk with margin, with leverage, with multiples on their orders, thinking anything they'd buy will continue to go up. This has led to margin calls and liquidations in their funds. We've seen it quite a lot in crypto. We've seen it quite a lot in the stock market in the past, in economic crisis periods where mortgages have gone bust. Banks go underwater. It's not great. So big problem. And finally, the most common tactic for a bull market buyer is usually buying and hold. Take this with a pinch of salt though, right? I don't mean to offend you, but most people forget to sell in these market conditions, and that is where the world of pain happens, because you could be sat there buying a stock at $300, and all of a sudden in a bear market, which we're going to come on to in a second, it's worth $90 or something. It's not good for the pocket. It hurts. Bear markets. In simple terms, it's the opposite to what I've just said. Prices are falling due to lack of interest, or after some extreme profit taken due to an extended run, or policy changes in terms of quantitative easing, quantitative tightening, all kinds of stuff like that, which we will come on to later on. This is where we will get lower highs and lower lows, creating a downtrend. So when you see oscillating data, as I say, go down, say you could have bought an asset at $300, it's now worth $50, whatever. Over a period of time, it hurts. And if you bought that level at $300 and you're sitting there with 70-80% of your portfolio completely destroyed, you're going to feel it. Opposite to a bull market is, people are moving away from it. People don't want to invest anymore. There's negative investor sentiment. People do not want to look at their portfolios due to that price point. It means lack of interest, which is a good thing if you understand the mentality of how to make money in the stock market or in an investment vehicle, whether that is in an index fund, cryptocurrency, or even property, buying up the lows, right? Because the real offer is money is made in the bear market. Because who doesn't want to buy low price stocks? Who doesn't want to buy a low valuation of an index fund? Who doesn't want to buy low Bitcoin cryptocurrency prices, right? The speculation on future price analysis and predictions are absent because the hype isn't there. The idiots aren't around. And I know that is quite offensive, but there's a lot of people who are making a brand over a following on stock market speculation in a bull market. You don't see them in a bear market, which is always a big red flag. To capitalize in a bear market, you need to take profit in a bull market or have some sort of capital available to you to enable you to reintroduce that capital at those low levels. If you don't have capital, you're never going to make money, are you? Size is a big thing. Keep your money, perfectly kind of poised to go into the market, because ultimately, if you can buy more units of an asset at the lows, you're going to do okay. And finally, be careful with the bear market rallies. These can lead to heightened emotion, especially if you've been starved of some price appreciation. Certainly if you've been sitting on losses for a long time and all of a sudden you got green candle, green candle, green candle, they could take your head off if you get it wrong. So failure as an investor, relatively straightforward. There's a lot of things that you can talk about with this. A lot of it's psychological, a lot of it's just due to lack of understanding, which we will talk about. So the most common is failure to, greed and speed is by being greedy too quickly and ultimately wanting to get rich very, very quickly. Often the hare and the tortoise story is the one where you need to relate to that. It takes time to grow wealth. It's a compounding effect. It does take a lot of time. We will talk about certain things around that. But if you get greedy and you want it fast, often you can get caught up in it. Overconfidence. Made a couple of trades, made a couple of whatever, and ultimately you win in a run and you're getting over cocky. That is one of the biggest problems that you get. We'll talk about this in more detail very, very soon. Fear. Markets have dropped, they've pulled back massively, your investments are down 10, 20, 30, 40%, and you just sell on a loss. Instead of doing the opposite, you are selling due to fear of losing even more money. Not having a proven plan or a system in place to enable you to understand what is happening with the market. Whenever the prices are high, taking profit. Whenever the prices are low, buy, dollar cost average, whatever you want to use, in terms of verified methods that do have a bit of case study in terms of what actually works as a basic investor. And not having the right tools or the educational foundation to help you. Often there's a lot of paid extras with investing. So you may get certain subscriptions for knowledge, for information, for education, for all kinds of stuff to enable you to make better decisions. The Dunning-Kruger effect, a very, very interesting psychological experiment in terms of how we as humans process everything in life. This is where, people with limited knowledge or competence in a given intellect or social domain greatly overestimate their own knowledge. It's like when you pick up a lot of roller skates or something like that, or something like going skiing, and you think, oh, I'm the bee's knees at this, I can do this, no bother, and you fall and break your leg or something. It's the same in investing, right? Once you start watching a few videos, you get into it and you're like, oh, I can do that. Then all of a sudden it dawns on you when it's the opposite way around, and you're like, oh, I've lost all my money, oh dear. There's often an element of this as well with overconfidence, very quickly becoming very, very good with investments, which is why a lot of people, and I don't mean to be disrespectful in any way, in a bear market, this educational course and learning crypto as a company over the last 4 or 5 years have found that we do better in a bear market because people tend to backtrack. So they'll be like really good in a bull market, confident, making money. Then all of a sudden when it turns on the head and it goes into a bear market, people are like, I need to learn, I need to understand what I'm doing. Oh my God, this is awful. Help. That does happen. It also means that, the more you know, the less likely you are to do something acting on knowledge. So what I mean by this is sometimes too much experience, too much information may lead you to not touch certain things. Like maybe myself in a way that I don't touch certain type of crypto assets or certain types of stocks because I know they're risky. I don't need to go with the risky ones. I can go with a more knowledgeable approach of utilizing cash size and returns as a value proposition. But some people don't because they want to make money quick. It comes back to that greed and speed sort of mentality, right? And finally, imagine the chart with peak stupid into a valley of despair and then an increased slope of enlightenment and sustainability. This is like life. So you start something first, you make an absolute balls up of it, you fall over. You then think, oh, I can't do this anymore. You throw your toys out the pram, you throw your games console across the room, whatever you do, right? And then all of a sudden you come back to it a few days later and you start getting better and improving. It's like picking up a guitar. You've probably quit millions of times and then all of a sudden you get good at it. This is what the picture looks like, if you're wondering. So you're thinking, wow, this is amazing. And all of a sudden you make an absolute clanger and then boom, you've given up with your hobby. Then all of a sudden you come back to it and you're like, oh, that wasn't so bad. It's very, very similar with investing. Influencers, the final bit of this, because I think it's important to know it, right? Now, most people fail is because they're copying others. Don't copy. Even though I keep a lot of my investments private, at the end of the day, if you're copying me, you're setting yourself up for failure anyways, because I am only human. Everyone else who is an influencer is also only human. Every investment you make or undertake or aim to be a part of could fail. And we've said that in the previous video. Bottom line is simple. They are your decisions that you are making. You need to keep them that. So you don't know or see or have even witnessed some early mistakes or issues any influencers had, myself included. I remember when I was first investing, I was terrible. It took a long time to get comfortable. It took a long time to know a proven strategy and a proven method that does work, which I'm more than happy to share, but ultimately it's not bulletproof. It doesn't work for everything. The obvious one is obviously getting caught up in the hype and the noise that leads to bad decisions. People with huge following or followers will get hyped up about an asset going well. As I record this right now, Dogecoin has gone on a massive run in the crypto world. Massive run. So some stocks actually in due to earnings, right? However, People get attached to the like button on Twitter or the view count on YouTube, whatever, do videos, hyping it up, just to try and create some noise. If you get caught up in that, you could be making a very, very bad decision in your investment portfolio. Remember, we're playing with money here, we're not playing with fake stuff. Not knowing if the influencer is genuine or, essentially been paid to sponsor it. How do you know if the influencer that you've stumbled upon has actually got that in their portfolio, actually genuinely care about it? Maybe it's just payments. Big problem if it is. And finally, not approaching the knowledge given with the correct time frame. So what I mean by this is that someone might be sharing an asset that they like and they're telling you to buy it with a chart on the screen or whatever, and you're like, this is all gobbledygook. But they might be thinking well, this is only a day hold, where you're thinking a long-term investment. You might like it, you might like the name, you might like whatever it does, but trading Apple or Microsoft or Bitcoin, whatever, you may think I might just buy that and hold that forever, bull market vibes. But the reality is you've approached it the wrong way, and you're just looking at them where you're thinking long term. You've got to understand that different people have different methods and different time frames as well. That is a big problem if you get caught up in the wrong ones. So let's talk about index funds. I want to keep it super simple, super straightforward, because it's a simple concept. Imagine having a big bowl and you've got a load of Skittles and you've just literally put them in the bowl. That is essentially an index. It is a load of stocks in one place. So it's a whole entire index. So it masks the volatility, which makes it much easier. So if I go down here, this is a load of other index kind of funds for, essentially stocks. You can buy into some of these, but some of them you can also look at as data. So for the US, for example, you've got the Dow Jones, a key one. NASDAQ, technology stocks, S&P 500, and the top 2,000, right? Then you've got other elements and variations of it. We've also got different ones. So, you got the Nikkei, for example. In Europe, you got the DAX, the FTSE 100 in the UK. All of these are index funds for essentially investors as well. So if you want to follow the top UK ones, you'll go to the FTSE 100 index, which is essentially programmed here, which is, essentially stuff like this. This is the sort of companies that are going to be on it. And it helps majorly if you know what's on what. So if we go back and look at the S&P 500, for example, here are some of the top ones here. Some of the top companies in the world. So it helps. Anyways, moving on to another thing. There's also other index funds that you can utilize yourself as an investor, whether it's in a pension, ISAs, however you want to look at it, right? In different countries, obviously this will be different for obvious reasons due to tax brackets and stuff, but one of the easiest ways to make an investment a bit easier and remove some of that risk is actually investing in index funds, because, as I say, it removes a lot of the volatility if some stocks have a bad day, because there's going to be some that will have good ones as well. So for example here, you can go on to Vanguard, and I use Vanguard myself, and you can set up whatever the hell you want, whether it is a general investment account, personal pension, even like an ISA, right? Go to the funds here, and they have their own funds, but they also utilize funds based off indexes. So for example here, they have a lot of their live strategy one. This is like full fund details. This is the one that I actually use at the moment, and it'll give you information about all the types of stuff that they've got. And you can see here a lot of it's coming through different variations. So you got Japanese sorts of European markets, equity markets, and all that kind of stuff, as well as different types of weights, which makes life so much easier. They also have distribution, so you can get paid as well, which is helpful. But going back, even though this is a Vanguard one, they also have funds which is pretty much in line with the FTSE 100 index, the Eurozone, the FTSE 250, even the S&P 500. You've got dividend stocks, which I'm going to come on to in the next video, but there's so much out here. Even the stock index fund for Japan, all the Japanese stuff, European markets. So these are all index funds that you can find. There's also other ones such as BlackRock, right? This is iShares, and again, it's very, very similar. You can get a lot of information online about index funds just based off what you can literally buy yourself and put your money into, and allow the index to do the magic. Now, over time, if I just change this price over the last 3 years here, you can see how the prices in the bull market have actually increased over time. So you're getting value appreciation. With a lot of these though, depending on your index fund and the provider or broker you're with, you'll get a distribution of wealth, which is called dividends, which does bring me on to the next video. But you will get paid from certain stocks, and they'll be automatically compounded into your index fund, which gives you that compound interest and allows you to keep growing. This is why dollar cost averaging the stock market is hugely important, and you can just keep on growing your wealth, putting your money to work. And if you're going to get like an average of 7 to 10% return on your investment over a course of time, some months will be worse than others, some years will be better than others, whatever you want to look at it. You are also getting distribution of wealth from those dividends, which is hugely important. So let's talk about dividends. Briefly talked about it. It's essentially a place for you. Well, I wouldn't say a place, but it's a stock investment or a investment vehicle that can pay you pretty well. You are a shareholder of a stock. Very different to other elements in crypto, which we'll come on to later on. But the company will make profit, hopefully, and they will be then distributed to shareholders as a percentage. We'll talk about it in simple terms so you understand, and I'll show you my portfolio to give you an idea, because I've just started my own UK one for transparency. I've put some money into it. I want to show you how it works in terms of compounding over a period of time. So let's talk about an obvious company, Coca-Cola, right? You've probably heard of it. Very, very simple. And when you're doing your research on any asset, whether you're buying UK stocks, whether you're buying US stocks, or even some European market stocks, there is going to be information that does it or does it not pay dividends. So you can see very clearly on this one here that you will get paid dividends essentially at this point. So ex-dividend date will be essentially when you need to kind of hold the stock, and then you'll get the dividend a month later, essentially. The yield is 1.76 in terms of the equity numbers, but it's an actual variable number of 2.95%. Okay, so if I go into more information in terms of statistics here, you can get even more information, right? So in terms of the yield, the forwarding yield, yeah. So basically the payout ratio is quite a big number. So they pay out so much profit, and not a lot goes back into it in terms of improving the method or the methodology of how to make Coca-Cola. Other companies very, very different, right? What you want is a rising dividend yield as well over a course of time to basically go up with inflation, because ultimately companies get richer as well with inflation, certainly ones like this. So there's a lot of information to take on board, but in terms of the fundamentals, more research is required than this. You can utilize a load of platforms, a load of websites to tell you a lot more information, whether you're using the likes of Seeking Alpha as a website, or some websites that I'm going to show you right now, which I use, is Dividend Watch, right? So this is a website I use. It's like $50 a month. You get some really simple sort of stuff. So you got high yield sort of stuff here. So if I click on this, it'll give me a load of information on a load of stocks, right? And it also give you a dividend score to see how safe they are in certain things. There's thousands of stocks that you can literally buy, right? Top tip, do your research. Top tip, do not go for the high yield ones. Look for some obvious ones, right? So in terms of my portfolio here, all right, just give you an idea. I've got a little bit of money in here, not massive amounts, but you can see the statistics here. Ignore this graph. There was a glitch on the server, as you can imagine. I didn't have that much in there. I mean, it'd be a bit mental if I did and then I took it all out, wouldn't it? But I didn't. So with this, you can kind of get a good gauge of what your portfolio is. So you can see here, I've got 15,000 in at the minute. I'm down a little bit in terms of the value equity, but you can see here, that's what the yield is. I am going to be getting, on average, roughly around 7% in terms of dividend returns over a course of time. These are the stocks that I've got. As you can see here, how many shares and the yield of each one. Some of them are quite high, so Rio Tinto's got a really high dividend, but usually they're not massively high. And you can see the average kind of percentage, so they're roughly around the same, give or take, depending on how the performance is doing. But in terms of the calendar, you can see when you're going to get paid as well, which is really blooming handy over a course of time. So you can see here, I'm going to get paid off one of them, Taylor Wimpey, £60 will go right into my account, happy days. And again, if I go to dividends here, you can see here roughly what you're going to get, obviously, over the course of that year. It's helpful. It is massively helpful in showing you this. But in terms of transactions, as I say, you can add all your stuff in and how much you're actually invested and what you've been selling and whatnot. So it's really, really straightforward. But as I say, it's all about the information that you need. And if you're starting to look at certain things, it's kind of obvious in a way when you think about it, like you are wanting to try and get as much information as possible. So if you're looking for a certain stock, whether that is, I don't know, actually, no, let's go Coca-Cola again. If I can get this one on. So Coca-Cola, for example, the information that you've got, much more detail on here. the dividends, right? It'll tell you the growth. So it's been growing quite nicely, quarterly payout, which is useful to give you an idea. Stock analysis, safety ratings, probably on average. There's certain elements that you need to kind of factor in, but if you want a nice little 2.39% yield, not too shabby realistically when you think about it in terms of Coca-Cola, for an obvious company that's been paying out dividends for a very, very long time. Obviously the cash flow, billions in the bank, and I think it'll tell you roughly how long it's been paying out for. On certain websites it'll tell you how long it's been undisturbed. So some dividends, essentially, some companies have been on a streak for 50 years, a lot longer as well. Some companies are also recession proof as well, but it gives you an idea. There's a lot of websites for information, but basically if you're buying the right stuff, you'll get paid every quarter or sometimes every month. And as you can see here, my annual income from this will be nearly £1,000 to reinvest. I can basically get free money and reinvest it in the market, and every time those purchases go up higher and higher and higher over the course of time, guess what's going to happen? The money's going to grow, which is what the next video is going to be all about in terms of compounding interest. Now then, it's hard to kind of demonstrate this, but there is ways and means to show how compounding over time does create, wealth vehicles. This is how the likes of Warren Buffett got very, very rich over a period of time. Most of his wealth came in his later years after he was 50, and it's just been going exponentially after that point, even into his 70s and 80s. Just ridiculous growth, right? The one thing with compounding is interrupting it is the problem, right? What you need to do is have a plan, and the plan is simple: dollar cost average into index funds or into certain stocks, allow the dividends and the distribution of the wealth and value appreciation over a course of time to just grow it. You're going to get two forms of payment. You're going to get value appreciation, where the stock or the value of the asset that you bought goes up in value, and also distribution of wealth, whether that is interest or dividends, right? So if we're looking at this as an obvious kind of situation, so if you're going to put an initial balance of $10,000 in, and let's just say an average, right? I know the terminology is a bit wrong, but they're using the interest rate here. If you are getting a yield of a dividend of say 5% over the course of the year, and you stick with a portfolio for 25 years, it's pretty important to note that you are going to get a very, very nice amount of money over a course of time. That is on average anyways. But when you start adding it up and you start seeing it, you'll start to see the growth in it. Now, this is only the interest earned over the course of time. Not massive, but ultimately you're going to start noticing something when I change it. That is only on an initial deposit with no further add-ons, right? Over a course of 25 years, you're going to make some money, right? But what about if you every single month add, at the beginning of every month of every single deposit, you're going to put a deposit, and guess what's going to happen? That's going to compound up. So if your dollar cost average into a fund, and you're going to get a distribution, whether that is 2%, 3% of the distribution of wealth back into the fund, you're going to start making money and notice the money going up. If you calculate it now, you've probably noticed a very, very big difference, right? You are literally putting in, a very, very small amount every single time, because every single year you're adding 12,000, and every single time the interest is just growing and growing and growing, providing it obviously stays stable. Now you've got to remember, your yield as dividends or your your distribution of your index fund will change every single year based on performance. Now this doesn't compute the value appreciation, because there'll be certain times where, you say if you're in the S&P 500, it'll be worth a lot more. Same with your individual stocks. This is just to show you that over a course of time, with a consistent plan of dollar cost averaging, and with what is getting added on and given to you for free, it's just going to grow and grow and grow. And when you've got a big enough fund, that interest over a course of time becomes, literally a retirement fund. This is how people say you can retire on index funds if you start early enough and you are sticking to the plan, because when you get an interest of 22,000, imagine that as a pension fund on tax relief. Imagine that being able to get withdrawn and it's not harming your entire equity portfolio. Madness, right? I know it's some people unrealistic, but I try to keep it as realistic as possible with 10,000 and 1,000 every single month. I know not everyone can afford that, but it's just to show you, the metrics over 25 years. You need to start as early as you possibly can. If you're quite young watching this, and learning about money for the first time, whatever. Earlier is better, right? I'm 31 years old. I don't plan to keep working or having any sort of commitment in a working environment when I'm 67, 70, when the retirement age is actually happening. I think everyone's mindset should be, I want to have as much money as possible so I can live on my own terms. This is where compounding comes in. Now, that's just compounding interest, and that is over a compound interval. What about if you're going to get it, every single kind of half month as well? It's a different kind of dynamic where you'll start to notice a bit of a quicker change because you're going to get paid quicker. Dividend is every quarter in the most case, so you've got to remember that as well when you're redistributing it. If you're automatically doing it, you're just going to create wealth over time. So I hope this has kind of helped. So let's talk about some monetary policy regarding quantitative easing and quantitative tightening. It has been the benchmark for the last 2 or 3 years, certainly since COVID-19, when we've seen a very, very different outlook on the world. I think for generations now, over 40, 50 years, we've not seen a market like this. We're talking new people experiencing new things in terms of the aggressive nature of why things have changed and how things have changed over the course of the last coming years. So quantitative easing is essentially a way for the Federal Reserve or, the Bank of England, the ECB, etc., to put money into the market, to increase domestic supply of money, basically to spur on economic activity, basically investing, right? When this happens, typically interest rates are low. It encourages spending, it encourages people to buy houses, to take out daft loans essentially on 0% finance. But when the music stops and things need to change, things do become a bit different, because what this gives us, inflation. You've probably heard of inflation since the news has been crazy about it. Inflation for a long period of time was relatively steady. And then it's gone back to generational levels, back to where it was back in the 1980s and the early 1990s, certainly in the UK. So quantitative easing, in a simple term, is belt feeding money into the markets, encouraging people to spend, encouraging people to go far too deep into their pockets, thus giving us higher increase in inflation because it dilutes the money supply. Now, when we talk about interest rates, this is what the problem was. So this is the interest rates in terms of the US market, right? So if we go over the last 10 years, you'll see very, very differently how things have changed over a course of time. There's always times of quantitative easing, there's always times of quantitative tightening. It's to basically, contract and, expand the money flow throughout demand, right? It's simple supply and demand. This has been very aggressive in 2022. So you can see that very, very clearly on the chart in terms of the previous kind of bout of it versus what we've got now. It is going through the roof. We're going to be over 5% by March, I believe, which is a lot when you think about it. Now, this is just the US version. There's obviously other versions for the ECB, the US. And if I go 25 years, you can see different previous levels. So you can see at the start of the century, we were at 6% interest rates. And you can see how it dumped and then it pulled back up. This is just monetary policy in terms of supplying it. And obviously the previous economic crash, this was crazy. They had to belt feed a load of money into the market to keep things up. So the opposite is quantitative tightening. It's essentially when we are trying to get the interest rates up because we're pulling money out. Interest rate hikes are happening all the time. So every 75 base points is going to 0.75%, which is obviously affecting mortgage rates, it's affecting savings, it's affecting bond rates. So now it's probably better off to be in bonds than it is to be in the stock market, because money is getting belt fed out of the stock market and they're putting it into safer assets, whether that is cash, whether that is fixed bonds or whatever. And even the bond rates of 10-year yields are going higher and higher and higher, which is basically telling you don't be investing right now because it's not going to be very safe. So when we start looking at this and the pulling money out, basically liquidity. And one thing to do this is to stop people from investing, to make people calm down, basically putting us into a recession, therefore allowing us to try and get rid of that inflation. Now, inflation is currently at record levels for a lot of places over the last 30 years. Huge problem. Therefore, we've got to get it under control. But it isn't really getting under control just yet. It's taking its time. But what we're expecting, this is probably going to go higher during quantitative tightening over the next year or so, give or take. And then we'll see it maybe stabilize. It's what makes the markets move pretty aggressively. It's why the data is very, very important. So make sure you understand why these and interest rates and the CPI data is very, very important. So what are cryptocurrencies? This is a brief outline. Throughout this topic, this whole section on the course, we're going to go through it in more detail through certain things that I talk about. So, this is very, very brief, and I'm hoping it's not going to take too much time. So the basics, you've got the obvious here. What is it and how does it work? So it is a digital currency or a virtual currency, but it's secured by cryptography. Basically mathematics, basically an algorithm that bolts on with security. I will talk about this in a much bigger concept with Bitcoin in the next video, certainly when we talk about mining. This makes it harder for the counterfeit, the double spend problem. The problem with real money, you can belt feed it out. You can fake it as well. Whereas with the double spend, which is essentially emails, imagine sending an image, you've got an image, they've got an image. Now, two of them, duplicates. One's the original, one's a duplicate. You can't do that with Bitcoin. You can't do that with cryptocurrencies, which is pretty good, right? With money, you technically can. Majority are based on blockchain technology, distributed ledger. Now, I will argue this. Most people know this about me. I believe that most coins are not required. Some are not. And you will figure that out very quickly as you go down the rabbit hole of cryptocurrencies. And then when you do your research, you'll be able to figure out, well, actually, does that need an asset? Probably not. And you'll soon figure that out pretty quickly. Blockchains are, and in my opinion, a great way to distribute old relic industries such as finance, law, and even more than that as well. So certainly stuff like logistics as well. Huge money pit of old technology and traditional values could be getting changed very, very soon. And blockchain can enable that. Cryptocurrency itself could pave the way towards a better financial future with more trust. Cryptocurrencies also have high price volatility, and it could also lead to some criminal activities due to the lack of regulation, because you can hide behind cryptocurrencies a little bit. Not as easy as people make out. It's nowhere near as bad as what the social media kind of, if that makes sense, social media kind of elements to it, and also the newspapers, what they report. However, if you send someone cryptocurrency and you don't know who it is, chances are you're not going to get it back. However, with fiat currencies, there's a lot of money laundering, there's a lot of ways of figuring out certain things with money. But for me, there are certain ways that you can do it. What are blockchains? So a brief outline of blockchains. I will go through different types of blockchains in more detail in a following video, which makes more sense. But essentially, every blockchain is different. Now, we're talking about the obvious here. Different forms of them in terms of the niche that they're used, the speeds of the transactions, the security levels that they have, and also how much they can actually store. Some of them a couple of coins, some of them a couple of transactions, some of them massive amounts. So it depends on what blockchain you're after. In simple terms, a blockchain is a connection of blocks in a numerical order. It stores data, in most cases hash numbers, and these are transactions. They are all done on a block basis by block, and essentially it's a record keeping device. Each block has a set time, so they'll fill it and then it will do it in its time it wants to. 1 second up to 10 minutes, whatever it may be. Each block is a set of transactions that have been verified by a member or each members within the network. These are usually computers, not people, by the way, just in case you get a bit caught out. So these can be like miners, validators. It depends on the type of blockchain though for this. The busier the network, the slower it is. Essentially, stuff like that is a big factor in terms of the spending costs of fees, which we will talk about later on in another video. Certainly we'll talk about different types of blockchain, certainly the Ethereum blockchain, and it will become more apparent as we go along. Blockchains cannot be stopped. They are decentralized to a degree, they should be anyways, and they cannot be rolled back. Everything that is validated is within the distributed ledger forever. So if you put a note on the blockchain, there's a note from Satoshi back in the Bitcoin days of the start of the journey. It's all on the Genesis block. You can still read it. It's still there. Different types of cryptocurrency. The most popular, obviously, Bitcoin. The king, in my opinion. Created in 2008, and it was, created by people or persons or whatever. Satoshi Nakamoto. We don't know who this person is. I quite like the mystery, to be fair. There are thousands of different types of cryptocurrencies now in the cryptocurrency space. Some of them are aiming to distribute industries, some of them are scams, basically simple as that. Some of them are massive, some of them are brilliant. Some of them are going to change how we think about finance and even basic stuff, right? Some of them are copy and paste codes, they're rubbish, and I will talk about that in more detail in further videos. Ethereum is the most common smart contract platform, a layer 1 blockchain which enables you to run smart contracts. Much different beast to what Bitcoin is. Very much a future throughput of what the industry is going to be all about and why it is connected in the way it is. You've also got layer 2 protocols such as Matic or Polygon, and this is essentially helping the Ethereum network scale because there is a few little issues with Ethereum, and I'll talk about that in more detail as we go on into it. You've then got stuff like privacy coins, Monero as an example. Just going to use one example here. Personally, don't like them. I think they are not going to stand in time with potential regulations. I understand why people use them, but there's definitely better things to do than store your money in privacy coins, in my opinion. Other cryptocurrencies are around, such as Litecoin. It's been around for quite a while now. It's probably one of the, you probably call it the silver to the gold of Bitcoin. That's what some people address it as. And for me, it's just a normal currency. You've then got a huge network such as Polkadot. You've got Near Protocol as well. You've got Atom. There's loads out there. There's loads. But as a network, as a layer 0, it's going to be a network for multiple different assets to run off it and sharing the same security. And then you got stuff like XRP, Ripple, helping money be transferred via banks and big, massive corporations between countries, so it's borderless payment. So these are a bit of a different stance of cryptocurrencies around. This is just the basics. I will go through this in more detail in other videos. Legal and regulations. Is it legal? More to the point. Yes. However, fiat currencies are authorized by and have an authority from governments or the monarchy, whatever, right? Cryptocurrency does not, right? That's where the difference is. Cryptocurrencies are legal though, right? So don't worry about it. They do come without regulation, so money protection. So in the UK, we have a thing called the Financial Conduct Authority. This enables us to be insured in case your bank implodes on you or whatever happens. In a lot of cases, you need to ensure that your cryptocurrency assets are stored safely. Next slide, we'll talk about this a little bit more. Plenty of countries have already stated that they are legal, and some countries have also regarded Bitcoin as an example as property. UK is one of those. In 2022, get my words out, El Salvador and the Central African Republic were the first countries to accept Bitcoin as legal tender for the monetary transaction. So they've actually adopted cryptocurrency or Bitcoin essentially as a way of spending money on their country, which is crazy. You've also got the likes of Japan, who have classed Bitcoin as property, same as the UK. And you've also got in the EU. They are legal in the EU, but futures markets you need to qualify. So trading derivatives, for example, you need to state certain things and more information to enable you to do that. Within the US, you have some problems with the SEC. This is quite common, most people know this. But certain cryptocurrencies you cannot buy or you cannot have any sort of partake in them because of the SEC. It's certainly on new assets or making money in terms of passive income. That seems to be quite a big problem in the US. A lot of people in the US get quite disheartened about this. Safety, again, quite obvious, but I need to talk about it. There is a risk of losing your cryptocurrency assets. When we talk about, safety and transactions and wallet addresses, this is the basics of it. Do not send it to the wrong network or the wrong address. If you do that, you're going to lose your money. Simple as that. You cannot get it back. Regulation risk. Some might fall in price due to negative policy adoption. We're in a world where there's no regulation. When there is regulation, it probably will upset the apple cart a little bit. Now, country-based banning, for example, India, for example, is a great one. A few years ago, every 2 months it was like an article coming out, India's going to ban cryptocurrencies. It used to cause chaos. Not anymore, but ultimately you get the idea. Certain countries will not like certain types of coins, whether they're high intensive mining currency coins, especially when we're talking about the world now with net carbon zero and all that kind of malarkey, it's going to be interesting to see how mining processes work, right? Just thinking outside the box here for the future. Even outlawing some types of coins, such as privacy coins, may well cause a problem if you're holding it. Simple, really. Now, this is another obvious one. Third-party risks. What about exchanges? What about if they get hacked? Mentioned just before, safety, right? You may have a problem if you're not keeping your cryptocurrency assets safe. Have you trusted someone with a wallet? Have you trusted an exchange to, store your own stuff? We will talk about wallets in more detail later on. But ultimately, what if something goes wrong? You could lose because there's no regulation, right? There's no third-party kind of element to say, oh, by the way, if we get hacked, you're covered. It's fine. Just don't worry about it. But reality is, you're not. Programming risks. Again, a lot of people say that investing's easy, that it's fine. As soon as you buy, you're going to make money. People forget this. No, you're not. Because anything can go wrong. Everyone looks at the success stories. So even what I was talking about in the previous videos before regarding obviously the S&P 500, the NASDAQ, etc. Oh, buying that is great. But reality is you've got to have success, right? Within a company, within a crypto asset, within a stock, within a property, within a car collection, right? Sometimes it just doesn't go your way, right? And the biggest risk with cryptocurrency is programming risk. And also the team imploding themselves. The team might have an issue with a smart contract. It may well cause a hack or an exploitation, and it could lead to price loss. That is a huge problem. Or worse than price loss, in my opinion, is sometimes liquidity loss. So the money's gone, and that's it. You can't even sell it. Gone. Scary. Another one, and the final one realistically in a sense, is market manipulation. We get this quite a lot in the crypto space. There's a lot of manipulation. Not massive, but it depends on what you're trading. If you're trading the big assets, it's totally fine. Don't even notice it. So that's fine. But if you're trading the lower cap coins, so what I mean by this is low valuation coins like penny stocks, they can be really aggressive, like up and down like a yo-yo. Really, really hard on you, especially if you're new to the space. So you got to be very, very careful with those ones. So welcome to the starting point of understanding some cryptocurrencies in a little bit more depth. Now, I could go on about Bitcoin very much at length in terms of like an overall course or a full section. This is brief, so please ensure that you do more research and ultimately understand a bit more. This is going to go through the obvious key points that you need to know before you start jumping in. Now, I believe a lot of other content creators are not discussing Bitcoin as they should be. I feel that a lot of new people in the space don't really want to buy Bitcoin because they feel that it's overvalued. I see that as I wouldn't say it's a bad thing, but ultimately Bitcoin is more of a wealth creation element. There's ways of creating wealth using Bitcoin. There's ways of using altcoins to ultimately get more Bitcoin. And you'll start to learn that throughout this course. Now, let's talk about the obvious. What is it, right? Designed to act as money, but in today's age, it's more like wealth. For me, I always say to people, have some Bitcoin. Just have a little bit. Just have some, because it's a good little portfolio stability kind of element. And it's a really easy thing to store. It's a really sensible storing point for a beginner. Bitcoin uses a Generation 1 blockchain. You've probably heard of a blockchain through the previous videos. But, as I say, people often laugh because it's very old, but the foundations of it is all about security. This is the biggest, most secure network on the entire planet, right? It was first introduced to the public in 2009 by Satoshi Nakamoto. That was when it went live. We will talk about the original origins very, very soon. It uses a proof of work mechanism, POW. Uses a lot of power. It's often, targeted for that, and we will talk about it in a bit more detail. But it uses mining protocols to enable new Bitcoins to be released to the market and to verify and validate the blocks, okay? Bitcoin has had a huge rise to fame in the last 6 years. Massive, right? Everyone, in my opinion, knows about Bitcoin. If you ask anyone on the street, then they have an idea what it is, whether it's a good opinion or a bad opinion. It's by far the most dominant cryptocurrency on the market. Even in today's market, in a bear market right now, it's double, triple the amount of volume that Ethereum gets, okay? The starting point of it, Okay, this is simple. It was first kind of like on the radar in August 2008. However, there was some little rumblings of certain elements, there was certain things like, I can't remember, it was Bitcash and stuff like that back in the day, like early on. There was all kinds of stuff around this cryptography kind of technology way into the 1990s, right? Not even in 2008. This was coming out during the economic bubble and the burst of the mortgage crisis, right? So the domain name was registered at that point. It was then announced on a massive cryptography mailing list. I've been working on a new electronic cash system that's fully peer-to-peer with no trusted third party. Now, what that alludes to is no banks. No bank, kind of element of a handshake, which is where the problems lie. So if you think about sending money from a different country, it's a bit of a ball ache, right? This is where it all gets a bit interesting. On the 3rd of January in 2009, the first Bitcoin block was mined, the block 0. It's known as the Genesis block, right? The time is now, chancellor on the brink, the second bailout for banks. That is a message that is contained within that block. As I said before, blockchains cannot be changed. They cannot go back in time. You cannot delete them. You cannot change the text. That is there for history now. The very first Bitcoin USD exchange rate was published on the new Liberty Standard on the 5th of October in 2009. You could get 1,309 BTC for $1. That is an incredible rate and price. Now, a lot of people will look at other cryptocurrencies and go, oh, it's just like buying Bitcoin of those days. Not everything is like Bitcoin. Bitcoin is unique in my opinion. There's a lot of altcoins out there that are relatively unique in terms of their use case. But this was unique. This was, one of the best generational kind of investments you're ever going to make if you were buying at those early days. The technology, mentioned it before, blockchain, the whole network to power it. Now, as I say, it's a generation 1 blockchain, so it can't do smart contracts. It's relatively cluggy, it's relatively slow, but it's unbelievably secure, right? Now, mentioned it before, previous bit, blockchain is a distributed ledger. That's a shared database, that stores data. It's public, you can view it, you can utilize it in any way, shape or form, right? When a transaction takes place on the blockchain, information from the previous block is copied to the new block with the new data encrypted, and this is all done via the miners. They're validating if you have money. Can you move that money from your wallet? Is it there? And can it go to that next wallet? Will it go? That is what they're doing, right? And what they're doing with this, and we'll go into it in more detail, they're getting rewarded for this. And this reward is a massive, massive factor in terms of why the price is so big and why the fundamentals of Bitcoin is so strong. Bitcoin uses SHA-256. It's an algorithm to encrypt the data stored within the block. Now you've got to remember it's encrypted data. And this is a massive hexadecimal kind of number that is utilized on every single block transaction. Huge. Now, talk about mining. Now, it isn't going digging. It is a series of supercomputers, right? Back in the day, people could have done this on a laptop, on a computer, on a machine. If you see anything that is telling you can mine Bitcoin and you get a slice of the profit, it is 100% a scam, okay? Want you to remember that, because when we go over scams at some point, it'll probably be mentioned there. There's a few things out there that claim to pay 2% per day. No. These are massive, massive warehouses, rigs on islands. They're freaking massive. It's a different game. So, how does it work in terms of transaction? This image kind of showcases it in a very, very simple, logical, cartoony way, right? So, say for example here, Alice wants to buy a product from Bob using Bitcoin. She basically opens up her wallet and sends over the money, but within that it's all done via encryption through private keys and stuff like that. We'll talk about those in more detail in security. But the transaction is then requested to be put into a block. These blocks are then built up, they're housed in on the network, and they're filled. Whenever the time limit goes, or whenever it gets filled, it then gets processed. And that's where it goes through the whole validation process. What the miners are doing is actually solving a very, very hard, complex sum to, decrypt it, basically, to send it through and to enable it all to go through smoothly, knowing that Alice has that money in her wallet to therefore send Bob. That is literally it, boring details, right? However, it's a lot more complicated than that, and it also is very, very powerful, which we will come on to in more detail as to why that is. Now, security, this is a massive, massive factor of why Bitcoin is still here today, and I believe it will be here for many, many years to come. It is a monster, right? One can argue that BTC value is similar to that of metals like gold, right? Both are very limited in quantity and have a select use case. Bitcoin is online. Bitcoin can be sent without having, the weight of gold is ridiculous. Imagine having $1 billion in gold in weight. You need an aircraft for it. You need your pocket for this. It's ridiculous, right? Double spending. Mentioned it in a previous video about, the problem that you've got with networks and sending data. You cannot get a double Bitcoin. You cannot have a double spend problem. You also cannot get a 51% attack, technically, because of the power. The power and the cost to enable this to happen would be very, very hard. You've also got to think decentralization. The miners of computers are all around the globe, right? They all have a share of the network. They have to get them all going the right way at the wrong way against something or against a certain block to cause a bit of havoc. To do that would mean ruining their whole entire business. It won't happen. It's impossible to happen anyways in hindsight. When you look at it, it's never happened now. It probably won't happen ever because the network is that strong. If it was going to be vulnerable, it would have been at the early days of Bitcoin. It hasn't been. Bitcoin's value is a function due to its scarcity as well. The supply over time is getting diminished as well. The one factor that you've got here with Bitcoin is the halving cycles. We'll talk about that in more detail. But also lost Bitcoin, like I mentioned it before, if you send it to the wrong place. One big problem with all this kind of basic stuff of cryptocurrency, if you send it to another wallet, it's lost. It cannot be re-enabled, right? It's what the whole blockchain's for. So there's only so much Bitcoin out there in the world. If everyone wants it, it's going to increase the price. It's demand. And then you've got the tradable kind of element to it. And you've also got fractions of it. It's a 9 decimal point kind of number. It's quite a big factor to it. So as you think of halving cycles, as you think of investors wanting it, as you think of more opportunities in the market and more altcoins to trade and the trading pairs you can get, it's very, very interesting to note that whatever the price of Bitcoin has been, keeps going up. It's a bit odd, right? And finally, the Bitcoin network has never been hacked. But one final thing regarding scarcity. There's only 21 million Bitcoin. That's the supply. In circulating supply, there's about 18 million. There's already 1 million locked up in Satoshi's wallet, and there's also probably about 3 to 4 million lost and not even able to get utilized again. So massive, massive factor. So let's talk about this in terms of security, right? The hash rate. This is a factor of essentially, simple terms, security. More miners on the network, more competition, more kind of validators on the network as well will make a big difference to the security. It's currently at all-time highs. It's a blue line we're looking for here. The market price is in US dollars there in the black, and it's at all-time highs. Now, it's incredibly strong right now for miners. Right now, there's no narrative to say that the miners are going to crash the network because they're still getting paid. They're still doing the thing. And even though there's a massive energy crisis across Europe and across the world at the moment, there's a huge benefit of actually mining Bitcoin, right? This will probably come down at some point, but will it crash the network? Maybe, who knows? But the biggest thing is with the difficulty adjustment. This is in tune with the hash rate. Every 2 weeks this updates. It's a bit different. The more difficult it is equals more power it will be utilized, right? So therefore, it's quite hard to mine Bitcoin at the moment because the difficulty adjustment's at all-time highs and the hash rate is at all-time highs. That would mean competition's high and also the competition to actually solve the puzzle. Hugely gamified, right? Massive. So with that as a factor, it's interesting to note that maybe if the miners do decide, you know what, over this winter, over whatever time period I want to sell up, I want to just sell some of my Bitcoin, turn off the network for a bit, chill out and relax, have no worries for a bit, they can easily do it because there's so many miners online right now. The competition's high. There's a lot of interest in mining Bitcoin in the big institutional kind of side of it. So that is a big factor. In terms of the price of USD, you can see over the history how things have progressed. You can see little dips. You can see in June 2013, like early 2014, had a little bit of a dip. A big one. Big spike, big dip. Mount Gox crash. We also had the first proper big, massive, institutionalized, glamorous kind of bull market, which I got involved in back in 2016, which is a long time ago now. But that was absolutely unbelievable. The speed and the ferocity of that moving from when I entered this market to like where it went to was unbelievable. And then we've got obviously the other stuff in terms of the bear market into the next rally up to $69,000 pretty much, which is absolutely mental when you think about it, right? So halving, mentioned it a few times. This to me is a massive narrative, huge narrative in the market. This for me is the reason why we go up every single time. History tells us that, and it's interesting. So basically the halving is the reward for the miners. Started off at 50, now it's at 20, it went to 25, sorry. Then it went to 12.5. It's going to halve again to 6.25 in the next cycle in 2024. Every year before it starts to rally up, people get interest, people want to buy and accumulate Bitcoin because it's going to go scarce because less and less is going to come into the market. It's an interesting, element that every single time we go through a new halving cycle or into a new cycle alone, we tend to just bottom out a lot higher and also go up even higher in the previous, from the previous cycle, which is a massive, massive factor, right? Now, the value. Gold is currently worth approximately $11.8 trillion at the time of recording. Bitcoin was worth 1.3 trillion at the peak of the previous cycle. Now, for every cycle, as I mentioned, Bitcoin has gone higher than the previous, which is always interesting to note on scarcity, right? Now, because Bitcoin has multiple uses and can be used across borders with ease, unlike traditional markets, it's a massive, massive play. Gold has been around for so long, centuries upon centuries. We still don't know how much gold is on the planet as well. Gold can be really factored in with how much is actually found. If there's more found, it could affect the value. If there's less found, it may well also affect the value. With Bitcoin, it's written in code. It's not going to change. You've got 21 million as maximum supply. You've got the utility of it, and you've got the lost Bitcoins, and you've got all the other bits and pieces, right? But you've also got the entire market built upon it, built around it, built through it. So huge factor that maybe the entire crypto market, which was worth at the time $3 trillion, could eclipse gold in the future, which is, in my opinion, pretty realistic if you're talking long term, if you're talking 10, 20 years time. Bitcoin is classed as a property in a lot of countries, certainly in Europe, certainly in the likes of Japan and stuff like that, digital property. You can declare it, you can pay tax on it, you can do all kinds of stuff with it. Pretty important, right? Now, the final bit that I want to go through is obviously recommended reading and listening. This is very, very brief, very, very brief, just to kind of whet your appetite a little bit. But there's a few things to watch and listen or whatever, how you want to do it. If you're listening to audiobooks, I recommend the Bitcoin Standard. It's very much in depth about money, but ultimately it goes a lot deeper in terms of what Bitcoin is. This one is really, really good as well. It's relatively modern. It's around when the pandemic kind of happened. So this one's pretty up to date. You've also got this one as a narrative story of the introduction, the core elements of how cryptocurrency became what it is. Certainly going through some massive stories. So this is about the Winklevoss twins in terms of their creation of Gemini and where they started. So it all goes about the start of Coinbase, likes of, Charlie Shrem, even likes of Eric Voorhees with Shapeshift, all these people right at the start, the underground of crypto. Really, really interesting. And the final bit is the obvious bit, is the Bitcoin white paper. Read it, understand it, look at it. It's a good read and it understands a lot about how the market is going to go in the future if we are going to go peer-to-peer, and we may be looking at, a little bit of an enhancement or overhaul of the traditional finance system. If you've not yet done so, please do check out our website. There's online products, there's premium and traders lounge. They're a bit more enhanced. It's all for you if you want to jump in. It's totally fine. There is also a free Discord. There's a link below to that as well. So if you have any questions and queries, feel free to ask in the Discord. Something that is new for 2024, certainly from the start of 2024, is ETF, exchange traded funds. These are here. for Bitcoin. This is the stats of what's been happening over the inception. 4.25% of the supply is currently in. Inflows, outflows, all the different ones. You've got Grayscale, which had a premium at the start, which is kind of why it's got a massive outflow at the moment. Then you got the likes of BlackRock, Fidelity, the two big ones. You can see the market shares there. Just to give you an idea, it is all legit. So what does this mean? This means that people who invest in funds can utilize the likes of BlackRock and Fidelity, etc., to invest and put a slice of their income or their wealth, whatever it may be, into a Bitcoin related product, right? It's all done in $1, but for this to operate, they need to hold Bitcoin 1-to-1. So you can see here, exploring how to access Bitcoin, the ways to invest, how they do it. So accessing Bitcoin enables investors to access Bitcoin, the world's leading cryptocurrency, within the traditional brokerage account. So it's within what they're used to, their own framework, and what they've probably invested in a long, long time through their own funds on BlackRock. The IBIT can remove the operational burdens associated with holding Bitcoin directly. It's a freaking pain. We all know that. It's a pain in the ass. But, they will look after it for you. Sounds a bit mental, I know, but custodian is Coinbase. And then you've got, obviously, the fact that they are the biggest provider, right? So it is relatively huge. This is a massive game changer for what it is. And when you watch throughout this course, you'll see that Bitcoin's a massive core element of what cryptocurrency is. All the other stuff is altcoins, and we're going to teach you throughout this course as well how to grow Bitcoin as well. The problem is, where do we go now? We don't know. This is different. So even though this course is all about teaching you how to do certain things, this adds a whole new dynamic of ETFs, right? So as you can see here, there's a lot of information, right? But there's also a lot of ETFs. This is just US. As I'm speaking right now, with this update, there's a new one coming out in Hong Kong. If the Hong Kong one's good, there might be a lot more Chinese users and buyers being able to look at it as well. And there may well be a Hong Kong one, and also a one that will be accessed from people in China. Pretty big. Asia's got a lot of volume. US has got a lot of volume. Europe, etc., not as good. But ultimately, Bitcoin's for everyone, right? So here we go. ETFs. They're all here. This is another one. This is Fidelity. Doing pretty well too. So yeah. So the next thing to talk about is the Bitcoin ecosystem. It is getting bigger, right? You can see on the screen, this is the top Bitcoin ecosystem tokenization. Obviously, it's quite high because of obviously Bitcoin, but there's projects like Stacks, for example. Let me just show you this, which is like a layer 2, activating the Bitcoin economy with a leading layer 2. So this is a start of it. A lot more projects are going live, which are built on another layer of Bitcoin. You're going to start seeing more stuff around stuff like this, ordinals. These are called inscriptions. They're based off like JPEGs and bits and pieces, but ultimately they are running on the Bitcoin layer. This is one idea. You've also got the transactions, instant payment, scalability, low cost, and cross blockchains utilizing Lightning. There's loads of stuff coming now, which is good. A lot of people have a misconception that Bitcoin is quite slow, sluggish, and it is in some cases, but that's all designed because of security. But when you use the Lightning Network and you actually have physically used it, it really works very, very well. There's a lot of exchanges now that operate with this, a lot of payment providers that operate with this. It works very well. It is only going to get bigger and better. So take your eyes sometimes away from the likes of altcoins, and a lot of altcoins are marketed around speed and transactions per second. But realistically, Bitcoin can do all of that. There's a lot of chains here, obviously you can see. Please do your research. Some of them are a bit rubbish, but ultimately there's some really good ones. As I say, like the Stacks, in terms of what they're building, pretty good. So time to look at some other cryptocurrencies. Not going to go too deep because ultimately it is down to you to do research, but it's good to kind of show the differences between a few of the bigger ones, or essentially the old ones, just to show you that everything is different to Bitcoin. Every single altcoin you find or want to invest in will have different consensus platforms, mechanisms, use case, the lot, right? So the first one, the obvious one, is Ethereum, the most popular altcoin essentially, right, in terms of market capitalization. First created by Vitalik Buterin in 2014 with a launch in 2015. Vitalik is relatively young, even still. He's been around for a while. He used to write in the Bitcoin magazine and stuff, and he used to get paid in Bitcoin to do so. Created, essentially the Ethereum white paper and built something pretty massive, in all fairness, considering his age, right? It's a blockchain-based platform, best known for its smart contracts. Smart contracts is the virtual handshake of an agreement, which is where most of the bulk of the work is done, right? In terms of agreements of transactions, money, all kinds of good stuff, right? It's changed recently from proof of work, so it was very similar to the origins of Bitcoin when it first started, to now proof of stake. This is still ongoing, so it's still going through the whole mechanism of this and the change, and I think there's certain things, as time of recording right now, there's still a lot to go, but it's starting to merge basically. It's currently the most popular altcoin, with thousands of different altcoins and other coins built upon the coding language of Ethereum. ERC20 is the most popular token in the Ethereum network. Basically, you can build one of these coins very, very quickly, very easily. This is why you get a lot of random coins, you get a lot of meme coins, you get a lot of funny ones. So if something happens in the world, people will make up something, right, about that coin, and they'll create the coin and put it on an open market. It's pretty mad how it works, but that's why you got to be careful. When we talk about scams and stuff, I'll show you how to look out for, the bad ones. But it's also, you got to remember, because it's so easy for a lot of things to happen, there's a lot of NFTs, for example, right? There's a lot of startups in the cryptocurrency space due to the ease of use for the developers to be able to do this. Copy and paste code. It is very simple, right? That's the whole point of it. The next one is Binance. Now, the BNB token has been around for a while. It's a very obvious token. It is the native one to the Binance exchange. However, in the last couple of, I want to say the last, maybe the last year, it's been very different for how Binance is operated and run. Why? It started off as an ERC20 token, as I said before. It's relatively easy to do so. But it's now had its own chain. It's called the Binance Smart Chain, right? It is a fork of the Ethereum blockchain. So it works on the same language, and the Explorer looks very much the same, and it works in the same way, but it just utilizes different wallets, but it's a lot cheaper because it scales differently. So you can modify it, right? You can use a token to reduce the trading fees or the smart chain functionality for obviously the utility of being able to pay for a transaction using a faster chain. So when Ethereum is busy, it's very expensive to utilize, whereas the smart chain on the Binance was a good alternative at the time. This is why it grew massively in popularity. Every quarter, Binance uses 1/5 of its profits to repurchase or burn the Binance coins held in its treasury. This gives it a bit of a supply shock, and it ultimately makes the price carry on going up over time. The smart chain is the second most popular smart chain platform, or smart contract platform, in the market. It is very popular. This is why it's gone from a really low value price from like $30 at roughly all-time highs before the big blow off to like $600, because it had a massive utility change and people used it because there was no alternative at the time. XRP. Not the most loved in the market, very honest with you. There's a lot of people that don't like it, but for me, it does its job. It's a digital payment network. It's a protocol that is fast and efficient, and it's got its own currency, XRP. It uses a consensus mechanism via bank-owned servers to confirm transactions. This is one reason why people don't like it, because it's got a lot of centralized ties. However, my opinion, most of the crypto is centralized anyways. XRP transactions are confirmed in seconds, and it costs very low, one of the lowest in the industry. If you want to move something fast, you do not use Bitcoin, you do not use Ethereum, you use XRP, right? Ripple is currently under investigation by the SEC. This has been ongoing for a long while now, a good while. It is the second largest volume on average behind Bitcoin. It is always doing high numbers consecutively, consistently. Even when the market's dull, it's relatively high because a lot of people utilize it for money transfers. Litecoin. One of the old altcoins and one of the first to use the open source code of Bitcoin, created in October 2011 by Charlie Lee, a former Google engineer. As I say, it was one of the first ones to create out of a fork of Bitcoin, essentially the open code, and it came with a lot of modifications, which I will explain. It was one of the first altcoins, which is always important to note, but it uses a POW network, but it uses a different algorithm. It uses script instead of the SHA-256, which is currently what Bitcoin uses and probably will continue to do so. The block generation time is 2.5 minutes with Litecoin instead of the 10-minute wait for Bitcoin. That's a massive change. So it's 4 times faster. There's also more coins on the market, which would indicate why that supply is very different. The halving rate's different. All of that stuff is different. This is what the modifications are for. It makes it a more efficient, cheaper, faster network than Bitcoin, but it does have the core functionality and the core foundations that Bitcoin laid back in the early days. Polkadot. Started by Gavin Wood, the co-founder of Ethereum back in 2016. It uses a nominated proof of stake consensus algorithm, which is very different to the others. It's essentially a layer 0, allowing parachains and relay chains to facilitate layer 1 blockchains and layer 2 as well to run on the same network. The difference with this is Ethereum is a layer 1, but it runs other coins on it. They're not layer 1s, right? If you want to run another layer 1, it has to be a native token. This is where it gets interesting. With Polkadot, you've got Polkadot as the shared security and the consensus mechanism for the utility of it, and then you can run a load of layer 1s on it, which is massive. So it's a very different ecosystem. The protocol allows different blockchains and networks to communicate and interact with each other. Interoperability. It's a hugely important thing, multi-chain. The main utility for the DOT token is governance and staking, but also the usage and the acquiring of the parachains and the relay chain. That DOT is going to be very scarce in the future. The bigger and more better these parachains become, and the more obvious they become in terms of how many they actually use in them, because the token will be a nice little currency. Some honorable, notable mentions, right? You've got Cardano, you've got the likes of Near Protocol as well, Matic, you've got Chainlink, Cosmos, Algorand, Quant Network, and Hedra Hashgraph. Now, obviously not financial advice. These are just some projects that are pretty big ecosystems that have been around for a while. There are thousands and thousands and thousands of different coins. Some are good, most are terrible, some are good, some are brilliant. It just depends on you. Throughout this course, you're going to learn about research later on, but this is just giving you a little bit of an idea that every project can be different, very different. You want to find the unique, you want to find the good, and you want to try and discard the bad if you can. So, cryptocurrency failures. I'll be honest with you, it's a hard market. If you are in this space, chances are you've already been in it, essentially, or you've came to our courses post doing things, investing, trying out trading, whatever you want to do. You found it probably hard. Often I find that simple methods are the best methods in crypto, and it is principles. But we're going to go through those principles throughout this course for obvious reasons, but I want to go through the negatives first because I find it important, right? The reason why this is lodged here in between this section is to just give you an introduction to the life of failure, because I think it's important. Now, the core reasons are simple. I'm going to explain it in one slide, nice and simple, because I will probably go back to it and look at certain principles of why things fail, because it is important, right? So the first one is the obvious one, is price hype. Everyone talks when it's a big, massive green candle. Everyone talks when it's on the news. Everyone talks in your friends' social networks and when you're at work or whatever you're doing, right? Dogecoin going to the moon. Certain things doing this, that, and the other. It's like, oh my god, that's crazy, mental. And all of a sudden you want to buy it. That's where it becomes a problem. Social media influencers will also add fire to the flame by, well, they put a lot of things, fire to the flame, fuel to the flame, nuclear bombs to the flame as well. They go mental. You've seen it. If you have any coin that you are interested in, If you Google it, if you YouTube it, you will see it. Mad price predictions, getting you caught up in the emotions and the hype and all that kind of stuff. You got to ignore the noise. It happens to me. When something goes mental and I ask for requests from people to do technical analysis, it's always that coin. It's always, why is this one gone bananas? Or I'm looking at buying this. Don't. Please don't. Over-risking in poor projects. You get caught out by the risk reward. You get caught out by the amount of multiples. Sometimes they've already ran. Sometimes they're no longer undervalued. Sometimes you just get caught up in the first two, price hype and the obvious social media influencer hype, but it's actually a poor project. It has nothing else going for it other than maybe it's a bit green for like the last 3 to 4 to 5 to 6 weeks, and it's like one day this will eventually turn around, and usually when you buy it, it does. Not understanding the core principles of investing, a big reason why people fail. Buy in, hold in. Buy in, holding. Buy in, holding. Buy and hold. Right? That's it. Not the obvious. And you're going to find out what the obvious word is. You need to realize profits from unrealized profits. You've got to buy low and sell high. You've got to buy at support, sell at resistance. You've got to do your research and find good projects and able to manage that portfolio. Something you will learn very, very soon. Changing methods or types of investments or investing that you want to do. Changing methods is mental. Like, if you got a principle and a methodology, stick to it. Just because it doesn't work once doesn't mean it's ever going to work again. Nothing is perfect in investing. You will lose money. Some things in the data will always be a bit odd because we are dealing with emotion. Emotions will move the market. Now, types of investment is I want to buy certain top quality assets, but all of a sudden when it's like metaverse phase or it's NFT mania, you want to just invest in those coins when in reality you've already missed the boat and all the good coins are going up and all your NFT projects are now going down. That is not what you want to do midway through, and you will lose. Not taking profits when required to. Simple really, it's same as the core principles, right? If you've made a 3, 4, 5, 10x whatever, you've got to sit back on the floor a little bit and humble yourself, because traditional markets, house prices, cars, antiques, artwork don't go up that quick. Crypto goes up fast and you get caught out in that price hype. You get caught out by, again, social media influencers, and you think that, oh, I bought this at that price, it's going to keep on going, it's going to keep on going, it's going to keep on going because this person, that person, this nugget on Twitter, whatever, told me this. Reality is, when that starts to happen, that is when you need to start scaling out. Lack of personal research in any project that you are looking to invest in. Clear and obvious. Don't have to explain this one. If you are buying what I'm buying, if you are buying what anyone else is buying, if you are buying whatever you find on the platform, just randomly buy it because you know that I'm in it, or if you know that Gaz is in it, or you know that one of the mobsters are in it or whatever, crazy. You shouldn't be doing that. You need to do your own research. Poor management of investments. Again, simple stuff. This is kind of like you losing it or leaving it on poor exchanges that have gone bust, for example. There's a lot of situations where that has genuinely happened. You need to look after your investments. You need to know exactly where they are, what they're doing, how much you got, are they working for you, all that kind of good stuff. Some people don't. And finally, leaving your cryptocurrency journey when the prices are down and it's a bear market. And then you come back when they're all back up again. More often than not, you're probably coming back to it and you're probably trying to figure out where the hell you left them. Are the exchanges still solvent? And how do you get them out your wallet? Because you've probably forgotten. That is a massive thing. If you are leaving the space because the prices are down, you're missing the opportunities to buy when it's low to make money. You've got to play with a game called probability. Something that you will learn a lot throughout these courses. There's different types of cryptocurrency project. I kind of alluded to it on the first video where we're talking about different types that run different ways and they do different things. Now, it's important to note that you're not over-investing in the same sort of thing. I do like an ecosystem, but sometimes they vary in terms of how they work. But you don't want to buy the same sort of thing. You don't want to buy all NFT projects or all metaverse projects because you're heavily exposed to one market. Each market in terms of niches and utility will work in a different way, which is important to know. So, different niches, different types of coins, right? You've got layer zeros. These are like Polkadot and Cosmos. These are a big ecosystem where they can scale much bigger. They've got layer ones running on top of it. Very, very different. Layer one smart contracts. These are essentially the likes of Ethereum. They work very well. They're very good, but there's quite a lot of them. This one by far is the most popular, in my opinion, trying to break through. You've got layer twos. Scaling solutions mainly came out due to the fact of Ethereum being quite slow. Layer 2 blockchains, they work pretty well. NFTs, non-fungible tokens, collectible stuff, very, very different, but again, projects that do run. Be careful with them though, it's based off hype. Remember, most of it's artwork. Metaverse, very, very new, untested, already been one element of a bubble, but again, new. Enterprise, blockchain solutions, or blockchains essentially designed for businesses, commercial use. Some of these are hidden in plain sight. Some of these do not have tokens, so you cannot invest in them. But as a blockchain, these are really, really good. Payment solutions, so the likes of XRP, useful. Even Dogecoin you can argue is a payment solution. There's stuff like Nano. There's a few out there that do help with payment solutions. Meme coins. Sheeb, Dogecoin, for example, they are memes, just currencies. Supply chain, stuff that runs in the supply chain. There's a lot out there for energy consumption, for logistics, for tracking of cars, all kinds of random stuff. There's a load out there, right? Even for like goods, privacy of goods, utility of goods, i.e., is it real? What's the state of it? Is it authentic? Exchange tokens, so the likes of Binance Coin, the likes of Qcoin, you know, there's loads out there that are falling into this as a utility for an exchange. You can buy them, you can invest in them, you can use them. Privacy tokens, the obvious one to hide things. Probably the one that you're probably not going to touch as much nowadays because of the threat of regulation, but people still use them. So market pairs, I'm going to keep this super simple. Basically, you can buy assets in more than just Bitcoin, US dollar, or even other altcoins, right? So if I go to BTC, for example, you can see here you can also get the equivalent value in Ethereum. Obviously, this is the USD price. Now, if you look at the likes of Ethereum, you can also buy it in BTC. So each one of that, basically this sum here is that price. Okay, so if you basically right click onto this, go into basically search, and you go to, well, actually it tells you that. That gives you an idea in Great British Pounds. If I change that to USD, bear with me, it is the same price what Ethereum is currently, right? Make sense? Good. Now with altcoins, you can buy in BTC, you can create BTC, or you can buy in US dollars and create US dollars. Therefore, you know, it goes up in value. Same with Ethereum. You can do it with a lot more pairs as well. Now, just to make this clear, it doesn't really matter what you're buying, it's what you're selling. What you will find is with different market pairs, it will confuse you when you go to exchanges. So I'm going to get it over and done with now before we go to the tutorials. When you go into the likes of Binance, now I am logged out of this. You get all this up here, right, on the spot exchange. A spot is essentially when you're buying the underlying asset, right? So if you want to buy whatever, you're holding it as an asset. You can see BTC pair. You can see a Binance pair. You can see Tether, Binance USD, and also you've got other altcoins as well, so the likes of Ethereum, XRP, Tronex, Doge, and Polkadot. These ones are a lot less, as you can imagine, right? There's not many on these ones, there's only a few, but the main popular ones is Ethereum, for example, BTC, buying with BNB, and obviously the BUSD pair, and obviously the Tether pair. You need whatever in your account here to buy it. So for example, if you wanted to buy in USD, you've got to have Tether in this account to buy it. You can't just put, you know, have Ethereum and just buy it with that. You've got to utilize the Ethereum pair for you to enable to do that in the BTC pair. I hope that makes sense. It's something that's often people overlook and forget about. But when you look to take profit, you may find that the BTC pair of your underlying asset may be much higher. It's called dominant, and I'll explain that in further videos across the courses. However, you can also find that if you're looking to accumulate units, that is a good way of doing it. If you're looking to accumulate dollars, remain in dollars only, because the main things that you need to understand here, building Bitcoin and growing your Bitcoin is a mixture of different things, right? Not many people, in my opinion, certainly over the years of teaching, don't want Bitcoin because it's too expensive, but then they pivot to it again. Every single price in whatever asset is basically crypto, right? How to get the USD price is via Bitcoin, right? So I'll show you a proper example. ICP, right? You can see here it's worth 2,123 Satoshis, right, in value, right? That is equivalent to $13, okay? If I press the search button here, if I move this into then USD, it equals the price. Kind of obvious, right? To grow your Bitcoin, you need to sell into Bitcoin, right? When that number is higher. Throughout this course, you're going to see about portfolio trackers in terms of how to track it. It doesn't matter what you buy. It just matters when you sell. So in an alt season, right, when we talk about dominance, when the dominance of Bitcoin drops, you can then sell your altcoins that have done well versus BTC into Satoshis, and therefore you have gained Bitcoin for free. Basically, that is what the price is here. Too many people do it in USD, but sometimes this will go down and this might go up only because Bitcoin has gone crazy. What about if Bitcoin does a 3x from now? Is worth 6 figures plus. But ICP may be worth, I don't know, $32. You might think you've doubled or tripled your money there, but actually you haven't. So it's hugely important you understand it. In terms of the market, you've got multiple elements to this, which is why the trading course is very, very important. But all of these BTC pairs are doing something. When they're high, it's time to sell. When it's low, time to buy. Simple investing strategy. When you're looking at the total market caps, the total to/BTC, for example, this is a good opportunity to buy altcoins in the BTC pairs because they're going to go up. But as I say, you don't have to buy in BTC. You can buy in USD and sell into Bitcoin at the other end when this is obviously higher. So it makes a big, big, big difference. Dominance is the biggest thing to understand. The higher this is, the more dominant Bitcoin is. Therefore, basically, your altcoins are low valued because it's getting slaughtered and pushed around by Bitcoin. Eventually, they do drop. And this is what you get with an alt season when they do drop quite significantly, right? They're hugely important. To grow your Bitcoin, you've got to use altcoins realistically, but also you got dollar cost averaging, being able to trade, all those kinds of stuff. You've got to figure out what to do. But everyone's different, right? Personally, I like to use altcoins to sell into Bitcoin at the lows, buy into them at the lows and then sell at the highs. Near Protocol, really good example of this in real term value here. So I was buying quite low at these low points, 3,000 Satoshis. We've been retesting this level quite a few times. I've been selling up here, made 3-4 times my money, which is quite nice. Could, hopefully, fingers crossed, go even higher. So yeah, stack Satoshis. People talk about it, but it's a good thing to do. So the final bit on this section is staking rewards, okay? Throughout the research section, you'll figure out what is, able to be staked. And what staking is essentially the ability to earn passive income by being, within a validator. A validator within the proof of stake ecosystem is essentially validating and verifying blocks. They're done over a period of time, i.e. there could be over 7 seconds, it could be 10 minutes, it could be whatever, right? Depending on the protocol. Now, let's look at Cardano, for example. You can see here a very, very simple logic of what it is. The market capitalization, the staking market cap as well. In the research section, we'll go through this in more detail, but in terms of understanding cryptocurrencies, I think this follows on nicely as a little extra ending. I have talked about dividends in the earlier section regarding stocks. Proof of stake is essentially having a stake in the network to enable better security and validation of the network. For you to do that, you will get a reward of, the tokens. Now, you can see here roughly around on average about 4 to 3.5% on average you're going to get, right? In terms of validators here. You can see here what you can make on terms of average at the moment. You can get a bit more depending on the validator. You can do a lot of projects on this. So for example, Polkadot, the average is roughly 14%, much higher. And you can see here how it all utilized, and obviously again, same details, how much is in staked, staking ratio. Now, every protocol is different. Every protocol has an unlock mechanism. It has how often you get paid. Some you get paid 4 times a day. Some you get paid once a day. Sometimes you get paid every 3 days. It just depends on the network, right? Now, this is all in aid of research, but we are going to go into research in much more detail to understand how the market really works, what is overvalued, undervalued. But most important thing, if you're in a bear market and you are holding the underlying asset anyway, so if you wanted to buy a load of whatever, near protocol, if you wanted to buy a load of Tron, whatever it may be, sometimes it's nice just to stake it, because even if you're making an extra 10 to 12% in the units, that is an important metric here, units, you're going to make some money if the asset over time appreciates in value. So let me just give you an example here. Let's look at near protocol. Now, all-time high was roughly around $22. Now, if we change it to units, it makes it more logical, right? So let's just say you've bought a load of it, say 2,000 units, and you're looking to stake this. You can see here roughly what you're making. Now, that over a year, it doesn't sound like a lot, does it? No, it doesn't. But you got to look at the metric here. If you're looking over a course of like a year, and let's just say the price goes up back to some silly levels, well, I wouldn't even say silly levels to be fair, I'd just say realistic expectation of the previous bull cycle. Now, that is a monster gain, and you're just sitting on an asset. If you're getting, an extra 192, it's worth $4,000. This is the whole point of buying when the market is low and just sitting on your bags, because it compounds as well. So there's compounding involved in a lot of these as well. So even if you change this over to USD, and let's just say you did put $10,000 in, right, which is quite a lot for some people, when you look at that metric, you're getting value appreciation of the underlying asset, and that's the revenue here, which is, if you think about it, quite a lot of money. It is pretty mental when you think about it. So you've got to be somewhat careful of obviously getting too caught up in the emotions of it. But in terms of everything else, if you add the compound element to it, you can see here that you can make a good chunk of money over a period of time, right? So in terms of value appreciation, it's pretty good, especially if the value does go up. Anyways, more in this in future videos. Researching cryptocurrency assets, a little bit boring for some. I recommend that you do your own research and you do this. This is a checklist. In the next video, we're going to go through it in real time, kind of. We'll miss a lot of it out though, just to give you a bit of an idea of where to go, what to look for. And most of the information that you want is on the official channel. So the websites, the official social media sort of channels, the documentation that you get if you want to read through it all. Anyways, this is a checklist. It is not in order. So, you may want to use some of these, you may not want to use some of these. Some of them are very, very niche, but they do matter a little bit. So the first one and the most obvious one is the purpose of the asset. What is it? Is it a layer 1 blockchain? Is it a layer 0 blockchain? Is it a DAG? Is it this, that, and the other? You just don't know, right? Until you actually physically find out. Until you got a purpose, you've not really got, when you're building a portfolio, you want to kind of find something to fit in it and like be a part of it. And when we go through the portfolio management, you'll find this out very quickly. You don't have too much exposure to certain things, or you'll start losing out essentially on other sides of the market. Community. How active, how passionate, how demanding are the community? Sometimes it's negative. Too much, it turns me off massively. Developer activity. How active are the developers? If you are on a blockchain, an ecosystem, whatever that may be, you want to see how active they actually are. If you are, involved in an ecosystem or a blockchain and there's no development, it's a bit of a red flag. So have a little look. The website, does it have one? What's it like? Is it good? Is it bad? If they're claiming to have 25 to 100 million in a seed raise and their website is very, very substandard, you may want to ask the question why. Tokenomics. How the metrics of the tokens work, the emissions, the inflation rate. Does it work? Is it the right thing? Is there enough tokens to go around? Are the team getting paid too much? Are advisors getting paid too much? And also, the last thing on this, we're going to explain about exposure to venture capital firms as well. The white paper. What information is on the white paper? Is it good knowledge? Is it good information? Is it up to date? Does it work? Is it, is it underlying the purpose? Is it underlying the future of the project? Massively important. And when the project is live, is it in relation to that white paper too? The team, who's involved? Do they have good advisors? Do they have good team foundations? Are they from big industries? Are they from Google, Facebook, Apple, Microsoft, all these big places? Some projects have some outstanding people involved. Transparency. Are they transparent? Do they tell you what's actually happening? Has there been any dodgy kind of dealings? Has there been any scams in the past related to the team? All that kind of stuff, it matters massively. False hype driving. This turns me off a lot of projects, this, be honest with you. When they're making up fake partnerships and putting on social media just to get a bit of price action, usually for the team to make some money, that isn't good. That, in my opinion, is a red flag. So make sure you look to see how they do announcements. Is it worth doing announcements? Stuff like that is a massive important factor. You can find that on social media. Revenue. Does this utility of a token make money? Has it got a staking mechanism? Has it got a governance mechanism? Has it got mechanisms to generate revenue for it to survive? Hugely important. Value. The market cap. We'll talk about the market cap in a bit more detail in the next video about research, understanding it. Is it overvalued? Is it undervalued? If you're buying something overvalued and you're doing your research, you'll probably find out it's not really worth it. Where to buy? What exchanges? Are they on good, well-known exchanges? Are they on exchanges that are safe to put your details into? Some, not so. Roadmap, kind of obvious. What's the future? And for obvious reasons, trading activity as well. Trading activity is hugely important. You want a liquid coin. You want a coin that has a bit of popularity. I get requests all the time asking me to look at a coin that's got like $80,000 volume. Buying that could be really risky because it may well have a bit of slippage, may well be a problem when you're doing orders. VC exposure. As I'm recording this, we're having a lot of problems right now in the market with VCs. They're buying too much risk, and then they're getting found out, and then they're going bust, and then that's leaving a lot of projects with a lot of exposure to them. Therefore, they're going bankrupt and they're selling the tokens to pay for it. That is leading for the prices to fall and obviously hurting investors. So when you're looking at this as an overall checklist, there's a lot of things on here. A lot of things are a bit wishy-washy, but at the end of the day, as a courtesy check, it's good to look at certain things, especially stuff like false hype driving, especially like transparency in the team. Because if they are a little bit of a bad actor in that team and they're looking to push up the price to sell, it's only going to affect you, the investor. So a little bit of a walkthrough on research. I'm not going to go too deep because you can be here for weeks and you should be realistically looking for a long time, right? Don't just look on the website, go, oh, that looks all right, and then just buy. There's a lot of things you got to look out for, right? But all this is going to be showing you the websites to look for, to have a little bit of a read. And the first one is obviously CoinMarketCap, but the reality is you might actually be here due to another factor. Social media hype, influencers, YouTube, etc. You may have found something flicking through, or even on TikTok, etc. And then you want to go and find out more information about it. This is where I would say the first two places you want to go to is either CoinMarketCap, or if you prefer the opposite, CoinGecko, right? Both very similar, both work in the exact same way. Basically a list of coins, right? When they're on here, they're kind of recognized. If they're brand new, chances are they're not on here. The reason being is because they're probably too new or they're just a bit scammy. These have got to get listed on here. So usually it helps, but reality is there's a lot of scams on here too. Anyways, what we're going to look at is, we'll look at Solana, random example. Just to give you an idea now, I do not recommend this because at the minute this is going through a lot of issues right now. So the time of recording, FTX has just gone bankrupt. One of their big coins, this is why it's doing bad. So let's do some research on it, right? What you want to find out is all the information. Now I mentioned in the previous video, market cap. This is a valuation of the entire market of this asset, basically 5 billion. What this is the price times by the circulating supply. That gives you that number. This is what everything is ranked in. So top Bitcoin, Ethereum second, Tether, USD, Binance, etc. Right? This is what these are kind of numbers are. So when you go into Solana, simple. You've got market cap, fully diluted, that means the total supply, and obviously the volume. The volume is relatively high at the minute because there's a lot of sellers, but it's just the way it is. And currently there's a lot of DEX volume as well at the moment. So information, if you scroll down, you find out some info, simple info. Now this is just a bit of information, not a massive amount that you need to know, but it helps you in terms of the starting point. You may go, oh, I might like this, I might go a little bit deeper. Other things to make note of: the markets. Where can you buy it? Is it on exchanges? Is it liquid? As you can see, we're okay. The news. As you can imagine, there's a lot of news here. Suspension of withdrawals, all kinds of stuff. A lot of, doomsday kind of stuff here. Price predictions, I would recommend you ignore those entirely. And more information. This is some little information on the tokenomics. As you can imagine here, pretty astounding in terms of information. Quick. Social media stats. Now I mentioned it in the previous video. Look for the GitHub stuff. The information is on here. Look at the size of the social media as well. And then obviously where can you store it is a good thing. Wallets will go through that in more detail. There's obviously some stuff here that you can't actually do, but hey, it is the way it is. Obviously you have a report here from this website here. So that's like basic stuff, right? It's very similar on the likes of CoinGecko. It's just laid out a little bit more different, so you can see all the information's here. GitHub here. So if you want to go into the GitHub, you can see when was the last time it was actually updated and all kinds of stuff, how many people, etc. Good information. Commitment is what you need. So that's the basics, right? As you can imagine, it's all the same. You see how the performance has been doing. Not great. What I do recommend though, and looking on, is a website called Messari, right? This is a really good website. Messari.io is a website, that's how you spell it. And this gives you more information, in my opinion. This gives you a lot more information. Now this is kind of like a Wikipedia, where a lot of information is kind of submitted by people, and it's obviously proof checked and stuff like that. It's relatively good. You can sign in, you can make a watch list and stuff. It's pretty, in my opinion, pretty good. I like this a lot. Now, when you go to the profile, you get even more information, a lot more detail, in my opinion, on the information. You can find out a lot more. You can find out about the previous elements of the roadmap, and obviously, the team. But the main thing that you want to look for is obviously, again, investors. These are the ones that are in question at the moment. Bit of strife, a lot of problems. But ultimately, the tokenomics here. You can start to learn about the tokenomics of the company and the whole entire thing of how it makes money. Is it a native token? What's it used for? The launch. How much money did they raise? What is going to the VCs? How much exposure does it have to VCs? This one has a lot. The liquidity curve. When does it kind of get put out? As you can see here, loads of tokens got put out, and even still going through a time into the next few years, the tokens are going to get put onto the market. This is why we're getting problems with Solana, because as they're exposed to VCs, they are selling because of the problems, and that's why the price is falling. But it's all down to you doing the research and finding this out about any asset, right? But this is where the information is. It tells you exactly what's happening. Now, this is just basic stuff. Basic stuff. Of a quick glance on a website. We've not even gone to their website yet, their documentation, their information, or their social media. So you get the picture of why you want to kind of look at these stuff, and like if you find some of the information up to date or out of date, however you want to look at it. Again, markets, volume, all that kind of good stuff. Metrics is a really good. This is a really good glance at information in terms of all-time high versus where it currently is now in terms of the price. Market data, massively important here. It's huge. It's so good in terms of information. The supplies, and obviously miscellaneous in terms of developer activity. So we're talking about developers. That's where you get all that from. Historic data, very simple. Prices and volume. You can see, look at the volume when it was obviously selling off quite severely here. It's like massive sell volumes. The charts, if you want to know information about the charts in terms of the real volume, the price, circulating supply, dominance, volatility, all that kind of good stuff. And the most important thing is obviously research. There's some good information here on the research written up by people, the state of it in terms of all the information. You can get a lot of information about the revenue mechanisms here. So the average transactions, the dilution of the supply, quarterly revenues. As you can see, it's got it all here. All the information that you need. So as I say, it's just a quick glance, because if I did a video on it, you'd be here all week. But main thing to go on to is their main website. So the Solana website is here. You can go on the website and find out all the information as well. I highly recommend, once you've kind of liked the idea of it by looking at CoinMarketCap, by looking at obviously Mazarian, etc., you want to go to the main website. You want to start reading the main documentation and looking at the website, and then you want to start falling down the rabbit hole. The one thing that I will always say is go to the learn section. On most websites have these learning sections, right? They want you to learn about their blockchain, about their infrastructure, about their protocol. All the information is here, right? And that's a good thing that you want to do, you know, realistically. If you want to look at the building stuff, you can obviously see what they're building, obviously use cases as well. So for example, payments, how much payments actually utilized on their, you know, the USDC network, on the Solana blockchain. There's so much here on information. But again, you got the network, the Solana scan, how much is happening on the network in terms of validations of blocks, the supply, who's doing what. It's really, really good information. This is what you kind of want. And obviously the tokens, all the different tokens that are on this ecosystem in terms of what they're doing, how they're doing it, and ultimately how big they are. So it gives you a good idea of like what's actually happening. Is it an actual working blockchain, as an example? And again, you've got all these transactions as well. How much is going through, obviously NFTs. Well, NFTs is relatively, you know, big on the Solana network as well. So it makes things a bit easier. Again, if you want to look at other stuff as well, there's other versions of it as well, and obviously the network status. But the main thing as well, the news, the events coming soon, obviously the whole resources for the community. There's so much out here. Now, the one thing that I can't find on here, unless I'm just been really like silly, is I can't find the white paper. Some places don't have the white papers anymore. They have like this documentation stuff where they kind of talk about how stuff is kind of happening, how to manage wallets and stuff like that. Some up-to-date or recognized companies like this don't have white papers anymore. It's just due to the fact that the white paper is usually like the imprint, the start of it all, and then it obviously gets kind of changed. But as you can see here, there is thousands of documentation on how to do whatever as a developer, you know, even as like, you know, as a learner, as an investor, the history of it all, terminology. You know, they want you to invest. They want you to do all this stuff and like help by buying a token and maybe educating others. Most coins have these. Most coins have information on how to become a validator, how to stake your bags, how to do this, that, and the other. You know, you got staking here, staking on Solana, how to do it, supported wallets, the command tools, how to create, how to pick validators. It's all there, which is great, right? Anyways, that's enough of that in terms of the websites. Obviously, if you want to go through and just go through it all and obviously click on the social media, you may want to look at the social media, see how many followers they've got. They've got loads, right? You know, a massive, massive blockchain, all the information here, you know, are they hyping things up? In my opinion, they don't have massive amounts of engagement in this, considering, in my opinion anyways, considering how many followers they've got 2 million, you know, 2.3 million. They get some, but not mega loads, but it just depends on what they're doing. Anyways, events. One thing that does make an asset do well is upcoming events. Now, this is where you can get caught in the trap. This is what you need to do your research for. 9 times out of 10, if you're doing research on an asset, it's came to you for a reason. Either if we're talking on social media, maybe if you're just doing your little research and you're thinking, you know what I want to do today? I'm going to go on CoinMarketCap. I'm going to look and find something I like. You may find something, a rough diamond in the rough, right? However, often when you're on social media or on YouTube or your TikTok, whatever, often it's a hype run towards something, and this is where this sort of thing comes in, where you want to find out what's happening. Now, again, every coin's different, right? If we want to find the likes of Solana, for example, we may well find some events, we may not. It just depends. So we don't look, we do. We have them at some blockchain conferences, basically, right? Nothing exciting. But go to the highlight section here. This is where all the big ones are. Theta Network, for example, big, massive updates. Obviously, you got Cosmos, a big update here. And this is the thing, they will get hyped up due to the anticipation, the speculation of said events. So be careful, right? Often, as I say, you will find that you will be caught up in the hype because of something about to happen. Hard forks, listing stuff, often they do pop off like a rocket, and this is where it gets interesting. So be careful. This is just coinmarketcal.com. It's a really simple website. But if your coin is on this, cool. But if you've bought something that's really high, it's up like 3-4 times its value since the bottom, it's probably because of something that's happened on here, and that usually is the case. The final thing I want to talk about, and it goes back to market capitalization. Risk reward value is one of the factors here. Now again, you need to look at certain things, certain aspects, and you got to do a lot of digging in terms of all those checklist stuff that I've got. So when we talk about the team, when we talk about development activities, social media, but the one thing that people often overlook is not so much that, it's this, it's the value. When you look at an asset and you are really into it and it's hyped up and all that kind of stuff, you may find that the risk reward is pretty damn poor. This tells you where you can make your money, right? So if I go on here, Solana, for example, you can see here what the growth is if it goes to, say, the value point in billions as market capitalization to Bitcoin. That will give it a price of $879. Pretty high. Solana was a very, very expensive project not too long ago. It was actually over $200 at one point, which is crazy when you think about it, considering it's now 13. Now, when we look at this, it kind of gives you an idea of what to do. Now, obviously, you can change all these kind of price targets to whatever suits you. So you may argue, well, actually, if this goes towards, say, BNB, it's not a bad little gain. It could obviously go much higher. But this is why a lot of people get caught out, because you may find that an asset's already ran 10x, 20x, 30x, whatever, but this puts it literally into perspective, and this is why it's a great website, thecoinperspective.com. Now, it does the maths for you. It makes life so much easier. So if we're looking at a lower cap coin, let's just have a look at like Decentralised, for example, right? If it goes to Bitcoin, it's going to go 419x. Now, currently, as we record this, it's a bear market. The chances are it's never going to go there. But even if it does go to certain price points, back to where it previously was, which was over 10 billion, which is currently Cardano levels, it's 14x in terms of return. It keeps you grounded. It allows you to see where things are. But if you're doing this at all-time high levels, where this was genuinely a really expensive asset, which it was at one point, you can see where the ceiling was. You can see where things have changed. Now, when we look at the likes of Decentralised, in terms of current market capitalization, it's 789. This was into the billions not too long ago. This is where you can see how the price has majorly fell. As you can see here, look at this. It was all the way up at like stupid levels. It was $5.20. So you can see the imagination here. This would have been much higher. So you can kind of get a grasp of it, and that's why it's really important. Now you can see here, there's a potential 40x on the market here in terms of where it's been in terms of all-time high and stuff. Crazy when you think about it. So I hope this helps you in a way. You need to do a lot of research. Most of the research will come from this bad boy, the main website of any asset. You want to start learning about the team, the transparency of it, how good the ecosystem actually is. Do they make money? Read all the reports, read all the information, read everything. It will take you like days, weeks to get ahead of it. It really will. So we're going to start talking about stuff that can move price, but also that can move money from your wallets into their wallets by you basically not being savvy enough to understand the difference. We're going to start talking about wallets very soon. It gets a bit complex, but first and foremost, fake news. A lot of projects will pump the market, but they're not just projects. They are people within the community that are looking for a quick buck. On the screen, you can see here Walmart and Litecoin payment news debunked by Walmart spokesperson. Basically, what happened was someone had a little cheeky domain name that was relative to the obvious, Walmart. And they utilized this in a way to put an authentic, at the time, a global newswire publication as a press release to state that there has been a partnership between Walmart and Litecoin. This obviously pumped the market. It pumped the entire Litecoin kind of situation. It went mad. And furthermore, what was mad was an official Litecoin Twitter account with a blue tick mark also, retweeted it. And it was absolutely mad to think how this was. And you can just see how this would absolutely pump the market. It's scary to think. And this was all due to certain situations around, obviously, a fake. One individual discovered the name of this and used the email to go onto it. So absolutely madness to think, right? And like probably an interim or whoever social media person got a bit excited and just retweeted it. So it's crazy to think how a community can do that. It's scary. This is why I say like the regulation side of crypto needs to happen. So be careful. Anyways, on to more traditional methods that you probably are aware of anyways, right? When we talk about phishing attacks, it is essentially a link. It could go through your phone, so you may well get these through your phone at times. You may well get them through your emails where click on this link to get this or whatever. It's often used to like steal your data, your login details, and you got to be very, very careful. The one thing that I always say, type in the URL. Do not go onto Google and put in, say, Binance, because if you go onto an adverted one, it might be a phishing link. You just don't know. You cannot be too careful. So always make sure you put the right link in and bookmark it, and always go to the specific one so you know. Because there's been times in the past, and I know it sounds a bit dramatic, but back before crypto was popular, people used to use Google AdWords in the Google AdSense sort of situation where they'd have adverts on the internet of a phishing link, and people will be searching for the term, so they'll be searching for certain exchanges, and it won't work. There was one recently for CoinGecko, talked about that just before, where essentially what's crazy is when you're doing your research, you're going to go into CoinGecko. If you go into the first one on CoinGecko, it's the main website, but this one time not too long ago, it was something else on top at the Google kind of advert side. As soon as you went onto it, it said connect with MetaMask. That is asking for permission to get into your wallet. Absolutely scary. So many people fall for it. So always make sure you do not click on links. And the one thing that I'm going to follow on from this, using the likes of Telegram is hugely important. You are savvy with computers. There'll be links thrown into chats all the time. There'll be data sort of things. And even as I record this, right, there's a whole problem with FTX. The exchange has gone bust. And one of the main players within this is called Caroline. There's rumours going around circulating there's a potential sex tape going around, which is madness to think, right? But that is a massive recipe for disaster because people want to click on the link, which could be a huge phishing link, right? It could be a massive, massive phishing link going all around social media, going around the Telegram groups, going around the Discords, and that could be a problem. So you need to be absolutely, turned on to the idea that, Facebook links, all these scams all over the place on groups, the Telegram groups as well. Make sure you understand that you are not clicking on these links. The last thing I want to talk about is the obvious, the 9 common scams that you get, right? For obvious reasons, this isn't the best website in the world, but it kind of makes me think less, essentially, because it's obvious. You got investment schemes. If someone comes or approaches you with, you can make 2% per day mining Bitcoin, if you're not that clued on and you've not done this course, you probably will be thinking, okay, I can do that. That's 2% a day. That's not massive. But already you know that the mining algorithm of how Bitcoin works with this course, you'll know that that's a bit silly. So make sure of that. Rug pulls. So we call these, the obvious, where essentially the developers do this. So they'll build a coin, they'll get the hype, they'll sell it, and they'll rug it, or they'll exploit it. So it goes to zero, which is scary. Happened here with one called Squid Token. Popular at the time, wasn't it? Romance scams, for obvious reasons. Dating apps are no longer stranger to it, basically asking for money. Asking for, can you send me some cryptocurrency, please? Remember, if you're sending cryptocurrency to someone, there's no trace to it. You don't know who they are. It could go anywhere. Scary, right? Phishing scams, obviously just talked about that. Man in the middle attack, hugely important. When someone logs into an account in a public location, scammers can steal the identity of that network, utilizing it in a public network, including passwords. So let's, for example, here utilize the world of McDonald's, Starbucks. If people know that you are regular in those places, if they see you on Binance, if they see you on certain exchanges, if they see you using hardware wallets, etc., they can attack a potential public network. It's very easy to attack a public network versus a private one. Obviously at home it's different. If you've got a really good solid, thing. Certainly where I live, I can see if someone's outside my house. It's very obvious. But if you're sitting in a cafe, for example, very, very interesting, right? I mentioned it before, social media. You see that quite a lot on Facebook, on Twitter. Ponzi schemes, again, similar to the first one, investment schemes, they kind of stick out like a sore thumb. If you're being promised, 50% per year kind of returns, you're probably going to be in a Ponzi scheme. Fake cryptocurrency exchanges, you see this quite a lot too on certain dodgy websites. Make sure you're aware of this. Obviously, you need to do your research on exchanges as well, not just like doing research on coins. Kind of covered it before when you're looking at liquidity. You need to go to a decent exchange where they've got the liquidity. If you're going to an exchange that you've never heard of, you've never seen it, and it's quite weird, you should probably just leave it alone. Always stick to the main ones. Always go to the main ones. And the final one is the recruitment offers. Not seen this firsthand, but I do, expect this to be about. For obvious reasons, if you're getting a job and stuff like that, there may well be certain situations where you could find yourself in a bit of bother. But hey ho, it is what it is. So please do your due diligence. This is just a little pre-warning about ledgers and wallets and stuff like that, because often you find that people are thinking, yeah, that's fine, I can do that, that's easy. But the one that's the most dangerous out of all these combined, in my opinion, is copycat accounts. I get copied a lot. I've lost my main Instagram. I had a big Instagram account, which I'm still a bit gutted about. I'm not really bothered with my new one. I had quite a few thousand followers on it, and yeah, essentially what happened was it got cloned a lot of times, and they basically binned off my entire account, both of them, which was annoying. So that was a pain. But yeah, people will copy me. They will copy me on YouTube comments, they will copy me in Telegram, they'll copy me in Discord, they will copy me on Twitter, they will copy me on Instagram and Facebook a lot. If you go on any of my Facebook posts, my page, you will see thousands of copycat impersonations of me claiming to go to a wallet and a link. It is there. I will never ever go into people's DMs. I will never ask a question. I will never ask, hello, are you okay, sort of bollocks, basically. But people do, right? People will fall for that, and they will think, oh, I'm on a genuine conversation with Ashi, that's great. Unless you need to get hold of me, use the proper channels in terms of the email addresses on the website, or even through the certain channels that you can go through, which are very, very obvious once you go through them. However, me going into your DMs, who you're thinking, that's a bit odd, and then the next message might be, oh, would you like to join this investment I've got going on, where you invest so much and you get so much return? It is a scam. This is the easiest way to do it, and we often say this in the world of business. If it works, keep doing it. So it's obviously working, which is a bit scary, right? So please make sure you understand that. So gearing up to that towards the next video on this course is about wallets and how they work. But I think it's important that we stick to this kind of situation first, because I don't want you to buy a wallet. I don't want you to understand how wallets work if you don't understand that actually you as an individual could be liable still, even with a wallet. You may want to be tempted to send money to somewhere. You might be tempted by an investment scam. You might be invested by me as a copycat in your inbox to send money to. It's all down to you. The wallet will protect you in terms of no one can get your private keys unless you give it to them. So make sure you're aware of that. Another thing I will talk about more in the next video is about potential ledger scams, which are very, very obvious when you know the fundamentals of how wallets work. So understanding wallets, this is going to be pretty painful and boring for some, but it has to be done in terms of the differences between a cold wallet and a hot wallet, and also some security tips to make things a little bit better. Now, hot wallets, these are the ones you want to avoid, but they are also exchanges. These are the obvious ones where you do not have your keys. So not your keys, not your coin sort of phrase comes to mind. We've seen in 2022, FTX has gone bankrupt essentially, never mind going bust. It's kaput, and a lot of other investment vehicles such as Celsius, Voyager have also made it so you have lost your money. These are only used when you want to sell or trade investment assets. Ensure that there's minimal risk to these, as we've learned, just said, regarding insolvency, bankruptcy, etc. If they go like that, guess what? You cannot get your funds. Same as well if you lose your passwords, if you've totally forgotten where you put your stuff, if you've lost your 2FA, you could lose access completely. And I will talk about that in more detail in a bit. Cold wallets, the good stuff, the Ledger as an example. Any wallet that has a seed phase. Okay, so this is a private key. We will talk about private keys in more detail soon. These are off exchanges and they have full custodian of yourself, as in you are fully responsible to be, in charge of it. You cannot get your seed phase lost or whatever, and I will talk about that in more detail on terms of managing that. They can be free to use, so the likes of MetaMask or other mobile wallets, or you can pay for them, such as Ledger as an example. Each wallet will have a different chain specification from holding certain assets. So some will be multi-wallets. These can hold a lot of things. You can also get native ones to the chain. So for example, here, Fearless wallet for Polkadot, Urori, or whatever it's called, for Cardano as an example. You've got Zillit for Zilliqa. You've got quite a few other ones. There's only one for Near Protocol as well. The one I mentioned just then about Near Protocol, you can also encrypt it with Ledger. So the one thing that you will find is when we go through the Ledger tutorial from start to finish, you can install apps on your Ledger, but you can't use it on Ledger Live. But you can use it on the ecosystem by basically putting it onto the website and encrypting it with that wallet. Now, back in the day when I was first investing in crypto, you used to copy and paste codes on the internet. It was crazy. Now you don't have to, thankfully. Private keys, hugely important. It's a secret number. It's a massive number, and it's using cryptography and cryptocurrency. It's basically an encryption. You have a public address. This public address is what you send your funds to. We'll learn all about that in more detail later on in this course. But the private key must be kept 100% hidden at all times, right? Devices like Ledger keep it hidden for you, so you cannot see it. What it is done, it's put into like a seed phrase, which I will explain in a minute. This is essentially a load of random words, and you'll see this in the tutorial. They are words like microphone, card, camera, speaker, dog, sausage. You get the picture, right? They're all random words. What this does is it masks it into an encryption for that long word, or that long hash phrase, or whatever you want to know it as. It's huge, massive. You won't be able to remember it. However, those words will encrypt it, part of it, as a 12-part piece or a 24-part piece, right? 24 is obviously the better one because it's much harder to kind of hack. That's the point of them, right? So they're fully hidden. Be careful with mobile wallets, right? I don't like them. I have a secondary device for these for obvious reasons, because if you lose your device, you could find that your wallet is exposed. If you do have additional security on your phone, such as Face ID, if you are in the iOS ecosystem, or other situations where you've got certain elements of PIN codes, whatever, that's better. But always remember, if you are putting your net worth wealth on your mobile phone and you leave it on the bus or something, that is a huge problem. So make sure you're aware of that, because one thing that mobile wallets do have a massive flaw with versus Ledger, you can reveal and move the private key. That isn't good. With a Ledger, for example, you cannot do that. Best practice is to use a hardware device. I have a Ledger link below. So if you scroll down, you'll see a little link in the text column. Buy one, honestly. Additional security. I know I'm teaching you how to suck eggs here. However, two-factor authentication, recommended. However, I always recommend this. Utilize another device. If you have an iPad, if you have a device that you do not take out and about with you, another phone, for example, or just something that, maybe your old phone, that will work. It's honestly, the stress of losing your phone, losing your device, and ultimately losing access to your exchange accounts, for example, would be a massive problem. So security is hugely important, right? This is an identity and an accessory kind of access management, method for like safeguarding networks and information. So when you get into an exchange, they will ask for this. They always do. The reason why I recommend this as well is, much better than utilizing email or a SIM kind of text message, right? Because realistically, a lot of people sack off the idea of using 2FA via the app, and they go, I'll just do it by email. but your email could be compromised. Often with exchanges, they utilize both of them anyways, but you want to use the 2FA on your phone. On exchanges, you may need one alongside the other. So often you see on Qcoin or Binance, they'll go, right, we're going to send you a number via email, click on that, and then you put that in, then you put in your 2FA. So it's a double combo, which does make it better. But as a single combo with just the email or even a text message is bad. You could get your SIM swapped and you've lost all your access, and you can get, you easily get hacked, very, very easily. I highly recommend you keep a backup as well of the keys to these accounts too. When you set it up, it will say very, very clearly that you must, keep this phase. It's like a 9-digit combination of text jargon, which you keep hold of, because what it will do is it will reset your device if you lose it, because you don't want to lose the keys, right? Some home tips. If you've got a hardware wallet, you need to keep it safe. So what you need to buy is buy a safe. Simple as that. Keep it safe. The seed phase will and must be kept somewhere safe. Dear me, people leave it laying around and you can lose it all. Recommended that you buy a safe for your home. It is also recommended that you buy fireproof wallets to keep in the safe as well, just in case, because most safes are not fireproof, would you believe? And the obvious one, if you keep, stuff safe, you may well have a secondary location, you may well have a safety deposit box, you may well have family members you can trust to keep it in their safe. Ensure you have something just in case, because if you've got a lot of wealth, you are responsible for this. This is not like using a bank. Banks are insured, but they're also responsible for your security. However, you can still get hacked or fraudulent kind of activity on there too. However, you are literally keeping safe a bit of paper on the most part, which is quite scary.
There is other types of wallets, obviously mobile wallets, hardware wallets, exchange wallets. There's also ecosystem wallets, right? This is relatively new. There's a lot more development in these. This allows you to engage with an ecosystem. So you got ledgers and Tangdem and other hardware wallets that do the overlying elements. So say Solana on the screen here, this is for Solana, right? But you can't really interact with all the Solana stuff like the NFTs or the meme coins. You can only hold Solana, right? So what this does is a gateway to the ecosystem for each individual asset. So there's a few examples here. So for example, here you got Phantom, Solana, all in one place, multi-chain, one wallet, no more switching around. This is actually a really good wallet, by the way. You got your NFT sort of stuff as well, meme coins, etc. It works very well. Obviously, Ethereum virtual machine. It's massive, really good wallet, highly recommended. Bitcoin. There's a Bitcoin wallet, Lever wallet. This allows you to get collectibles such as ordinals. It allows you to obviously add stacks plus BRC20 tokens too. So a bit more than just Bitcoin on here, which is good. It also connects with other wallets as well, but you can manage it all in one place. Polkadot ecosystem has their own wallet. Nova wallet is probably the best one. Massive. It has absolutely everything. All the networks, cross-chain, multiple connectivity. You can stake on here, you can swap, you can do all kinds of, as well as NFTs. Huge. Algorand, per wallet. This is an interesting one. Really easy to use, but you can get access to all the little meme coins on Algorand. Very, very fast, very, very efficient. It works very, very well. As you can see here, secure, store, whatever. The NFT side of it, swap instantly. Works very, very well. And also Near wallet is another one, getting more popular with NFTs and earning, and obviously all the dApps too. Connect through all this, hugely important. But these are just a few examples. When you're doing your research on any asset, you can find out what is in there, information. Supported wallets here, for example, right? You can click on anything and you can find out what is, the wallets that they do. And you will find very, very quickly they'll have their own, and it works very, very well.
So what we're going to do in this video is talk about MetaMask, a tutorial on how to get it set up. Now, I have just gone on to Firefox, and all we're going to do is put in MetaMask in the search, and it is a brand new install, so we need to make sure everything is correct, so we're not going to go down the rabbit hole of the wrong thing. Go to metamask.io, and what we want to do is download it for this browser, which is Firefox. You can use Chrome, you can use Brave, most things, right? It is super straightforward, and all we need to do is add it to Firefox. Super straightforward. Obviously allow it to have the permissions, and essentially what we've got here, you know, if I just move my screen a little bit so you can see, you'll have a little, you know, element here. It's just a little fox. It's cool. That's what you want to press on, right? Once you press onto that, you will get welcome to MetaMask. Very straightforward, I know. Get started, super simple, I agree, and all kinds of stuff. Now again, certain situations it will tell you here never to do, you know, in terms of what it never does certain things. So you are trusting this to not essentially ruin your life by nicking your keys. Now, I mentioned this before in previous videos, you can import a previous one via recovery wallet. This is what it looks like. So if you have an existing wallet, you will have different types of key phrases which you will have. We don't have that. We're doing a fresh install, right? Which, you know, all you need to do, press that. Now, we want to generate a password for this. We will be using this wallet throughout the course just for ease. So when we go to decentralized exchanges, how to use it, you know, functionality of how to do an address and all that kind of stuff, right? We will use this wallet. So I want to just make a random password, which makes sense. If it will work, it might not even let me have this password because it might not be secure enough. Oopsie. There we go. Let's see if it let me have it. I do not want to save it. So all this does here, it will give you a 12 key phrase basically, right? And there's a video here, not teaching how to suck eggs, but feel free to watch the video. It will majorly help you because it will tell you how it all works. Even though you know what it works and how it works, it will give you a much better element. However, this will tell you a lot of things. Now, for me, I always say, write the buggers down, store it in a bloody safe, and keep it bloody watertight. If you do have a laminator at home or wherever you work or what office you're in, try and use a laminator. It may help, especially if you get water damage. Just a top tip there, but it's just one of them things. Now, key thing I want to say here, do not copy these, right? This wallet will not be used ever again. It won't have any decent fundage in it. Certainly by the time you watch this video, there'll be probably no funds in it anyways if you wanted to steal it. Now, this is what I know, I said it before in previous videos, they are random words, and you can see here, stick, clock, buffalo, odor, host, rebuild, owner, vicious, select, immerse, symptom, and again. They are all random ass words. Now, what I need to do here, I am going to take a photo. Do not recommend you do this. The only reason why it's a burner wallet, so I'm not going to be using it for any funds. What you need to do in this period of time is take a photo of it. I'm joking, don't do that. Write them down. Write them down. Store them away. Do not write them down and scan it and fax it somewhere. Do not take a photo of it and email it to yourself. Do not send a text message to yourself with the numbers on it. Literally get a pen and paper, write it down nice and neat. If you want to type it out, utilize a laptop that is not connected to the internet and that has a wire within the printer. Pretty old school, don't use a wireless printer. But if your handwriting's neat, just write them down. As I said before, if you want to laminate it, do it. If you need to put it in a safe, do it. If you want to put it in a fireproof wallet, do it. But this is how every wallet starts, right? So I have them because what we're going to do now, we need to put them in order. We need to put the keys in order, right? Which is kind of a pain in the ass. But at the same time, this is just roughly how it works. So the first word was stick. The second word was clock. And this is going to be very boring for people who have set up wallets before. But this, as I say, is exactly what you will do in real time on every wallet that we mentioned in the previous video. And yeah, it's just one of those things. It's the exact same with Ledger, which we'll do again with Ledger, but I'll probably do that in a much quicker way. But at the end of the day, we are going to be using this wallet. So there you go. You've got a wallet. Boom, that is it, done. So functionality of the wallet is simple. The next video we're going to go on to will be about how to change the chain, but we are currently on the Ethereum chain. This is your wallet, this little bit here, right? Again, if you want to send tokens, you press the send button and you type in the wallet address that you want to go to. If you want to buy stuff, you can buy on here as well, which is pretty clever, pretty good as well. If you want to look at the portfolio side of it, you can. You can connect your MetaMask to this and you can look at the portfolio, which is pretty clever. It's a new feature. And again, you've got the swap feature as well, which will enable you to do smart contract swaps, utilizing the decentralized side of it. There's a lot of stuff on here to unpack, but if you want to get Ethereum, all you need to do is utilize the address that you've got. Now, if you press this little button here, view account details, this is your wallet. You can export the private key. Please do not do that in real time, because ultimately you're going to cause a mess. If you want to view the wallet on Etherscan, you can. This is the wallet here in question, and you can view everything on here. If you want to name it and put learning crypto course, you can, and you keep it super simple, right? Now, as I said before, this again, information for you. Highly recommended you do this. Now, if you do this and you go ledger, it will connect to the wallet on your ledger. So all the stuff that I've just done beforehand doesn't matter. If I press this button and go to continue, it will basically go, right, you want to connect the wallet on your ledger to this? Yes, please. That is fully private as well, but it will use the functionality of MetaMask to control it. So basically, if I want to go to certain places, I can. Oopsie, I've gone to the wrong place. Back to my ledger, please. Back to my MetaMask, sorry. There we go, it's here. But you get the picture, right? It's very, very straightforward. If you want to utilize it in certain ways, you can. But the reason being, I've kind of cocked this up by going to the wrong place. So if I go to, back to here again. There you go, you can go back into it that way. I was just confused. But yeah, if you want to use the full MetaMask utility here, you essentially need to press on here. That's it, simple. But most of the time it is here. Obviously, it was in big format before. Now it's in small format. There you go. You go to expand view. I did wonder how I did that. So there you go. That is MetaMask. It's super straightforward. Once you get to figure out how it works. But yeah, with regards to the ledger side of it and all the other, hardware wallets, as I say, it will just do it to the ledger wallet, which is fully private keys, which makes sense. Anyways, next video we'll talk about changing the chain, which is a really cool functionality. So, core functionality of a wallet, just to kind of go over the obvious here in terms of sending and receiving. Okay, I have put a little bit in my wallet. So once you have something in here, for obvious reasons, it's straightforward. You can see it. You can see the whole Explorer ID and how it all came to the fees and whatnot, right? For you to actually send it somewhere, you need to get the corresponding address. So you need to go to the source of where you want to send it to. So if you want to send it to an exchange, you need to go to the wallet and you need to go to Ethereum to send Ethereum. So this is Ethereum, right? If you have Bitcoin, send Bitcoin. You can't put BTC on here for obvious reasons, but you can obviously use other ERC20 tokens, which we have talked about before. They will obviously appear down here in your tokens. Now, if you go to import tokens, you can obviously search for them. Whatever kind of token that you've got, you can put it in there if you so wish to, or a custom token with a token address. That's a bit more complicated, but it doesn't really matter these days for that. So if you're looking to send it, this is what it looks like on MetaMask. So basically, you got send to. You need to copy the address in. And when that happens, all you need to do is put in the amount that you want to send. And I'll just show you how it works now. It's super simple. This is like the easiest thing that you can ever kind of do. And we'll send it over to this wallet and we're just going to put $5. It will take a bit of time to do this because it is quite a slow transaction because of the size of it, essentially. So when you go to the next, essentially it's going to take so long. It's going to cost you 40 cents, but it's going to take out, with Ethereum, this is a big thing, it will take out the fees via Ethereum, okay? So when that happens, and it will refresh as well, depending on how busy the network is. Now, this is just the Ethereum wallet. Again, similar sort of wallets will do different things. Every different native chain will have a different native kind of functionality and core process. So it makes sense. But right now, as you can see, it keeps changing. But what we're going to do, go to confirm, and that's it. It is now sending over to that wallet. And all of a sudden, it will come up and it will say complete or whatever. Now, this could take, depending on how congested the network is, it could take quite a while. And there we go. It has been sent. Pretty quick, that, to be fair. But once you do it, you can go onto the Explorer on Metascan and you can see it was done very quickly. So that's pretty good, to be fair. So that is essentially it in terms of core functionality. If you want to swap stuff around, you can. A little bit different this. I've never actually fully used it, but you can swap it to different things and you can have it on the chain. So if I wanted to say use this, you know, I've never done this before, so this might be a complete balls up. If you wanted to put, say, that into there, it will review a swap and it will swap it into USD, sorry, which is mad when you think about it, but we won't be able to do that because we haven't got the fees. The reason why is because I put too much in there. So if I just change that to that and just review swap, it'll fetch all the quotes now. And again, it's the fees are the problem. We're playing with little, but you see the picture, right? So you can be able to swap it on here if you wanted to, and then ultimately, you know, it'll be in your assets here, which is making sense. So a list of assets will be on here, all Ethereum-led tokens, pretty awesome. Finally, I said it before, with this, you can obviously utilize this if you so wish to. You know, if you wanted to import your MetaMask onto this portfolio website, just to keep things super simple for a bit of management, you can. And you can kind of go through it and see what's happening with obviously your address, how much Ethereum you've got and the prices and whatnot. And most importantly, all the networks that you can, you know, utilize or bridge. It's pretty good little system if you wanted to just have something simple. Anyways, that's that done. Core functionality of the MetaMask wallet for Ethereum. We're going to go over onto the next video and we're going to talk about how to swap over in terms of different kind of networks and stuff like that. Makes sense, but you may need
So over the last few years, especially if you're in the UK, you can probably skip this if you're not in the UK, the FCA have been really strict on exchanges. Now, this page here is a registered cryptocurrency asset firms, right? There's a couple that you probably recognize on here. So obviously you got like Gemini, you know, Fidelity, Bitpanda, CoinJar. There's a couple you probably will remember. But there's a lot that are not on here that we like to use. For example, Binance, KuCoin, for example, right? You got BitGet, even Swissborg. There's a lot on here that, yeah, you can use. They're, you know, well-established, you know, UK regulated, and yeah, you can use them as on-ramp, off-ramp, whatever the hell you want. That's totally fine. Problem is, there's restrictions with how much you can use, your KYC requirements, all that kind of stuff becomes a problem. So just a big word of warning. Cryptocurrency in the UK is getting harder to achieve in terms of buying and selling, on-ramp, off-ramp, and most importantly, just usage and being able to use stuff. There's even some cases where, like of Exodus Wallet, let me just show you this, bear with me. I should have had this prepared, but I totally forgot. Exodus Wallet in the UK, there's a little bit of a problem here. You can see it. Limited availability of services for UK clients. This is where the problem lies. So we need to be so careful what we do. So please ensure that you do your research, okay? It's massively important. But most importantly, just understand what's happening. It's an unregulated space. Some people are not sure of it. And yeah, people are making decisions in offices and have never invested or done a full research before, and they're going off losses in the bear market. Every market has losses. The FCA are more than happy to authorize sponsorships of, say, BingX, which is a crypto exchange for Chelsea Football Club, or other kind of cryptocurrency related sponsors for, you know, other sporting events. They allow gambling, they allow people to gamble, and it's all sport, it's totally fine. But to invest, it's different. So please make sure you understand the risks. And if you're in the UK, good luck finding an exchange.
So cryptocurrency exchanges, let's get into this. I know I have mentioned the word exchange quite a few times, and the understanding of it will get better as you go through these next few PowerPoints. Now, these are just basic terms. We're not going to do many walkthroughs of exchanges because they all look very much the same. There's certain terminology that you need to be aware of, which is what I'm going to highlight, and obviously how to do research in exchanges. Each country will determine what exchange you can use as well. So I want to keep it quite slim on doing talkthroughs on exchanges, right? So these are different to brokers. If you're like me and came from the regulation side of finance, which is essentially, you know, your IG, your trading 212, places like that, they difference between an exchange and a broker is very much different with obviously cryptocurrency. Now, most of the exchanges in crypto are not protected by any regulation. There's only a handful, literally a handful. They're open 24/7. It is cryptocurrency at the end of the day, so you can sign up at any point. You can do know your customer protocols at any point, and you can buy and sell on a weekend with no issues at all. Fees are taken away in terms of withdrawals, but it is still cheaper than traditional brokers. A lot of traditional brokers take a long time to do withdrawals. They will take a lot of fees per buy, per sell, and also a transfer or a trade. It gets very expensive in the traditional market, and a lot of people moan about the cryptocurrency fees if you're using the Ethereum blockchain or if you're using certain stablecoins. But crypto to me is still very much cheap. And wallets are hot. They are at risk. They could be exposed, they could be exploited, so you need to use and abuse them. So cryptocurrency exchanges. What does spot mean? Well, spot is when you are buying the underlying asset. So you are physically holding that asset and it is in your wallet. Derivatives. Simple. It is trading with leverage. It is trading markets. Something that I do not recommend for the novice. Exchanges also offer different services such as earn, copy trading, NFT trading, vast majority of different things that you can utilize on an exchange. And exchanges are responsible for your funds, not you. That is the scariest part. We've seen that very much recently with exchanges going under. They hold the keys, not you. And if exchanges do go bankrupt, that's it, gone. Those funds will be liquidated, they will be sold off to kind of raise money, and you won't see that money again essentially. So as I said before, use and abuse. Key terminology. Okay, this is quite obvious, but limit orders. If you want to buy an asset at a set price on spot, you put that in. So for example, if you wanted to buy Bitcoin at $12,000, you put $12,000 as a bid and the amount that you want. Market order. This is when it will order at the current available price. Remember, any exchange is where there's a buyer and a seller. You are buying from someone who's selling. That's how it works. It will give you the most closest order and the most convenient order immediately. Stop loss. This is only to be used in futures. I don't get why people would do this on spot unless you're trading spot, but if you're an investor, you don't need to worry about stop losses because you have obviously bought. You need to sell at a high. If you want to sell on your own steam, feel free to, but a stop loss is massively important when you're using derivatives in the futures markets because leverage, massive player in that. Deposit. This is what button you'll press for when you want to deposit funds, whether this is fiat, whether this is, Ethereum, Bitcoin, whatever it may be, via your wallet or even via your bank. This is the button that you'll use. A withdrawal button. This is when you want to move money out of the exchange to your wallet. Simple terminology, I know. Wallet, go to your wallet. You can find out what's what. Very simple. P&L, profit and loss. This is your unrealized and realized profit, especially if you're looking on your dashboard on Binance, for example, you can see how bad or how good you've done. Network. So when you're doing a withdrawal or if you're doing a deposit, you will need to select the right network. A network is hugely important. It has to be the corresponding one. Usually on Binance, it will do it automatically for you. It will give you the most obvious one. So if you're doing an Ethereum address, it'll do it by Ethereum. If it's Bitcoin, it'll do it by Bitcoin, right? Very straightforward, but do not get them lost. Margin. So on spot, there's a little button that says margin on most exchanges, which will just put a little bit of a nibble of exchange fundage on there, a little bit of a leverage. Recommended you don't touch it if you're new. It's the sort of thing that you do as a trader. Convert. One thing you can do is convert into another asset. So if you've got Bitcoin and you want to convert it to Ethereum, you can do this in a button of a click and it'll do it at a market order execution. So bear that in mind, right? An obvious one is Launchpad. What does this mean? Obvious to me, but for you it might be different. This is when a new product or a new project is being launched on the exchanges. This will allow you to get some new tokens. If you're holding the underlying asset, you can then get that coin. Staking, part of the earn protocols. Some exchanges offer staking where you can stake a asset. So for example, Binance BNB, you can stake that on the exchanges and you can earn some passive income. Fiat, what the traditional normal term is for real money, your pounds, your sterling, your euros, whatever it may be. Volume, what volume is the asset doing? It's a terminology that you'll get used to. It's something that you'll see all the time on exchanges, and it's a great way to see if something is busy with trading. Pair, again, same as volume. When you're looking on an exchange, you'll see the pair. Do you buy it in BTC? Do you buy it in Tether? Do you buy it in Ethereum? So a little bit on exchange security. Because you do not have the keys, you have to also be mindful of your device as well. Certainly if you're on mobile, certainly if you're on laptop, there's some situations that you may find yourself in where your exchange is vulnerable. So the must-dos, the obvious is set up a two-factor authentication. If you want to go a little bit deeper, feel free to use a VPN. Personally, I don't. Just due to the fact of my location, I'm constantly in the UK, it's fine. Sometimes that causes problems, but one problem that you do not want to have is 2FA. Make sure, as always, you keep a backup of your key for this so you can get into your device. What I recommend with this as well, using a secondary device, as I've said before, for the application, because why do you want to be out and about and you lose your phone and you lose all your exchange access, which is not good, especially if you have limit orders on, especially if you're trading, especially all kinds of stuff. Crazy when you think about it. The obvious one, turn off your text message authentication. This is like the soft version. This is a huge risk if you are at risk of being SIM swapped. If you're using a normal number, it's amazing what people can get, and you don't want to use that kind of capability to kind of, lose your data. Not good. And use a non-personal email, so it's clean, risk-free from phishing as well. So if you're using a normal email address, cool. If you're using your generic personal one, just be mindful. Simple checks, these are very, very obvious too. Always check the URL of the exchange before you do anything. Make sure you don't just plonk one in on Google and go to the fastest, quickest route to your mouse click, which makes sense, but if it's a dodgy exchange, you don't want to do that. The next video we are going to talk about researching exchanges. Never click on an exchange link from an unknown source, an unknown individual on like a Telegram group or a Discord or somewhere you find on like Reddit, whatever. Make sure you just type it in. Realistically, you get no benefit from just clicking on a link when you can just go directly to an exchange itself. Always check the wallet addresses and networks before you start moving assets. Please, this is the biggest one. I've said it many a time already on this course. Always check. Don't save passwords on devices without 2FA. So for example, my laptop here, if I leave it sitting and it's logged in, guess what? Someone can get onto that very, very easily. If there's no 2FA, they can do whatever the hell they want, which is scary. And the obvious and the last one, only use exchanges to transfer money on, to then buy, and then off, for then into your own wallet. Okay, if you've got limit orders on, remember the risk management of it, right? If you're waiting a while for orders to go through, that's your risk. But don't put your entire stable currency bag on there just in case something goes wrong. So cryptocurrency exchanges, as we've just talked about, you also need to do a little bit of research too, not just in the capacity of obviously where you're going to go, but how busy are they? Do they have liquidity? And are they safe? Now, obviously, talking about it just before, no exchange is safe, right? You've got to use and abuse. Go to CoinMarketCap. Now, this is a little bit biased because Binance own this. You can utilize CoinGecko, these other websites too. And what I will do, actually, I'll put both of them on just to give you an idea of what the difference is between both, because I think it will majorly help you understand the differences between the both. So we'll do CoinMarketCap first. Go to exchanges and go to spot. All you are looking for is, the information that where you want to buy. Now, country dependent will depend on where you can buy. If you're in America, sorry, it's a bit of a pain in the bum. You've got to go elsewhere. But you can see the trading volume is what you want to look for. You want to look for good volume. You want to look for good weekly visits as well. But also you want to look for this little check mark. Now, this is all new. These little reserves are literally brand new. because of FTX, because of what's been pushed around the industry, a lot of people are calling for a lot of exchanges to put their reserves up online, and you can see the reserves here. So this is KuCoin, for example, right? Now, again, you can see other ones now. The likes of Coinbase is on the financial stock exchange. Their revenue mechanism is a little bit different, and also so their reserves. So they're probably not going to publish their reserves. They're going to let the stock market do that for you. So you just got to look at that fundamental kind of element. Now, one thing I will say, if you click onto it, it'll give you all the information about said exchange, where they're located. Kraken, pretty good if you're in the US, for example. You know, it's available to all US, except those that live in Washington and obviously in New York. But you can see there's a lot of countries that you cannot buy a lot of, you know, cryptocurrency assets. It's just the way it is, I'm afraid. If you're in any of those countries, you're probably going to struggle. But fundamentals of any sort of research is, you know, liquidity. You know, average liquidity, this is what you want to look at. You want to go to the top end of the tree. If you're scrolling all the way down and looking like, let's go on to something random, I don't know, something totally random, that you may struggle to get liquidity, I don't know. Yobit, for example, has a massive reputation for basically scamming people. This is, in my opinion, a pretty dodgy exchange. It has been around for a while. I wouldn't recommend it. You can see very, very clearly there's not much volume on it. Like some of these pairs here are like, you know, nothing happening. If you get trapped in any of those just buying it willy-nilly, you're not going to get your orders in. Remember, an exchange is literally a buy and a sell between two people. You've got to go into the right places, right? So you can see there's a lot of exchanges here. Derbit, for example, random. That was a popular one, no longer it is. You can see, like, we're at the bottom now. There's a lot of these exchanges that are pretty damn dodgy, so make sure you understand that. Anyways, going to CoinGecko, again, similar sort of, you know, situation here. Go to exchanges, click on the, you know, the top bit. These do a thing called trust score. Now, this one I don't think is as good. You've got reserve data as well. Yes, they do similar to what Binance have done. They're basically taking the same sort of information from the other website, essentially, but you can see it's a bit harder to read, in my opinion. This one's just going like pretty, in my opinion, pretty high up. So you got to be careful. But the one thing to look for, as always, look for the volume and obviously the web visits as well. So you can see what is popular, what is not. Coinbase obviously popular, Binance obviously popular. You know, you get the picture. It is relatively straightforward. So that's it. You know, you need to do your information. You need to do your little checks. When you click on it, as I said before, you can see all the information that you need in terms of the volume, you know, about the exchanges where you can buy them from, liquidity sort of stuff, any sort of incidents and stuff like that. You know, they're all put on here. Again, similar sort of situation with the reserves, statistics, and obviously the trust score. It helps massively in terms of getting all this information in terms of what you want. This trust score should be massive for this because it is regulated in terms of like the currency exchanges and stuff like that, which is pretty big. Anyways, next one is more interesting, promise. So the final bit about exchanges is decentralized exchanges. These are a little bit different and you need to be aware of them. So if you go to the exchanges and go DEX, this gives you an idea of what's what. You can see what the most popular ones are. We're going to use Uniswap in this instance just to make life easy. And, you know, there's a lot of different variations. You've got PancakeSwap as well. This is basically the Binance chain. But the main ones are ultimately these ones here. You know, you got a swap. Some of the ones with the order book is a lot better, more decentralized, and you can do more trading on those ones. But what we're looking at realistically is swap. What these are the new assets, the brand new stuff, the new liquidity stuff. And it gets pretty chaotic realistically, but it also gets very, very expensive, right? Be careful. In terms of the fees and stuff like that, it does get pretty mental, so just be careful. If you go onto this, click onto it, you can see all the different stuff out here. There's quite a lot, but as I say, you can buy, as you can see here, a lot of random stuff. Not recommended as a beginner. Anyways, if we go into the app itself, this is it. This is what it looks like, right? So if you want to connect a wallet, super straightforward. You've got your Ethereum, the token that you want to buy or swap to, and then obviously, you know, all that kind of stuff. So let me just connect my MetaMask. So we are on an unsupported chain, but what I need to do, move over to the Ethereum chain. There we go, swap the network, boom. So I've got loads of Ethereum, as you can imagine. Not much, but it's the same sort of thing. So if you wanted to move stuff around and play around with stuff, it is super straightforward. Now, it's not hard. You know, if you wanted to move it into BUSD, you can do the max and the conversion, and it'll just convert it for you in terms of that as a swap. That is it. You know, this is how the swap ones work. You can see the fees here, very expensive. The fees are stupidly expensive. If you go into tokens here, you can see all the different tokens on here as well that you can obviously get. There's loads. And this is it. This is literally what a decentralized exchange is. The big thing with it being decentralized is you are connecting it to your wallet. So there's no depositing or withdrawals in that sense of an exchange. You're actually using whatever Ethereum is in your wallet, and then obviously whatever you're buying will then go into that wallet. Very, very straightforward. As obviously you can see here, it's already recognized that I've got some metas. If I wanted to swap some of my metas here, which is only a small amount, I can move this into Ethereum with a button of a click. So if I just press maximum on here, into here, I can get 3.13 Ethereum, and that's a fee. Done. And I don't have to worry about sending it over to an exchange to then swap it and then do it. You know, it'll probably be cheaper me just pressing the swap button and off it goes. So that's it. You know, straightforward. They're all very, very similar in terms of how they look, apart from this one here, which looks a little bit different, as you can probably imagine. Once I show you this, you'll see it looks more different. So this one's got a lot more weight to it. You know, you can do some actual orders and positions on here. It's very, very different. But as I say, it depends on you. Personally, I would always recommend Uniswap for simplicity. It is super straightforward. You can't really go wrong. And it obviously connects with your MetaMask as well. So let's talk about something very, very simple, but also something you should be very mindful of in crypto, because it varies to the stock market. It is a very, very common method. It's called dollar cost averaging. You've probably heard of it. It is a simple way for basically an individual to constantly buy into a stock without any technical analysis knowledge. If you want to learn more about the technical stuff, it will be in the next course. It's a proven method that does work in the stock market and very, 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 very popular in index funds and pensions. By basically over a period of time, you are gradually putting money into things. It does need to be adapted for crypto. It really does, because there is some big problems which I will talk about in a bit. Anyone can do this with a set plan. There's mobile phone apps now like Moneybox, Plum if you're in the UK, where it will gradually take out a little bit of a percentage of your income essentially, or your wages, whatever it may be, out your bank, and it will put it into index funds, for example. That is a proven way of dollar cost averaging, putting a little bit in at the right times over a period of times with consistency, which eventually gives you that compounding interest element, which is hugely important, obviously. By no matter what the price is for the time period, right? So this is what the idea is, okay? Over time, you'll be buying an average price for assets over time. So for example, I'm going to give you one. With Bitcoin, let's just say you bought some at $60,000 once, but you bought it multiple times at 20,000. Eventually over time, that dollar cost averaging will go down towards that 20k level, because you can buy a lot more at 20k in terms of more units you'll buy versus at 60k, for example. The problem can be over risking. This is where the problem lies, because you constantly just do it. You constantly just put money in, you're constantly just doing it. And sometimes it's automatic. You probably put auto invest on, and all of a sudden you're putting $100, $200, $300, $500, however much you want to put in every single month. And all of a sudden you got a load in there. You're thinking, oh my God, I've got loads in here. So be careful with your over risking. The plan for crypto, I mentioned it before, it is a little bit different. Cryptocurrencies, you got to do it when the market is low and stop doing it when it's high, because often the bear markets are brutal and you will lose a lot of money. Often in crypto, some coins will die. You don't want to dollar cost average into a dud coin, do we? No. Stick to high cap proven assets for this method, using only profits from these purchases into more risky plays. So distribute your profits from that point. Set a percentage of your salary and set up a timescale. That makes life so much easier. So if you're going to put 5% of your salary in over a period of 3 years to get into a position, dollar cost averaging over time, that's a great way to start. And it will gradually over time build up. And then you can have profit potentially, and you can then utilize that profit, withdraw it, do whatever you want to do with it, and make a fully functioning portfolio that is no longer at risk. That is the key aim. Use common sense though, right? When you believe the market is too high, stop it and look to take some profit from those existing low orders. If you've been doing it for 2 years, and let's just say 2019, 2020, dollar cost averaging into cryptocurrency, thinking this is awesome, this is great low prices, I can do this. And then all of a sudden 2021 comes and 2022, where the prices were ridiculously high at certain points, you've made some money there at some point.
So something more advanced for building your Bitcoin is dominance. Dominance of Bitcoin. Now, to understand dominance, you need to understand the metrics of what the price is of Bitcoin and ultimately the Satoshi pair. So we talked a little bit in the course about basics, building Bitcoin. We talked about market pairs. Now we're going to put in an element of managing your portfolio correctly by being in altcoins at the right time and being out of them at the right time as well, right? So let's keep this simple. The next course that you do is all about technical analysis. Don't worry too much about the candles. If this is too overbearing, sorry. But if you go on to the likes of CoinMarketCap or CoinGecko, at the top here, it has a dominance figure. So you can look at that if you so wish to. If you click on it, it'll give you a load of charts and a load of information, but it also gives you dominance, right? Simple terms, right? The price of your asset is all in Bitcoin. I know, scary. If you go on to anything, right, it has an 85.45 sort of price for Litecoin. It also has a Satoshi price, but now, weirdly, the one thing that annoys me is CoinMarketCap no longer display it. So go to CoinGecko. I just want to show you this as an illustration, okay? Go on to any asset and we'll use the example of Litecoin. Now, it gives you a price of BTC. This is the price of the asset. Press search. It's simple. This is in Great British pounds. We want to put it into dollars because it makes more sense and it gives you the exact same price, right? So why does this matter, Ash? Well, it does matter massively because when dominance is high, the Satoshi values of your altcoins are at their lower points, mostly. It's an index at the end of the day. I've got a real life example I want to show you. The second video will show you why you need to sell into Bitcoin essentially or take profit when dominance is much lower. So picture this, dilution of squash, orange juice, blackcurrant juice, whatever. When you have a higher concentration, it's going to be stronger. When you have less, it's going to be weaker. That is the exact same methodology you need to think about here. When dominance is high, it equals that dominance is more dominant versus the 2 gazillion million altcoins that are available in the market for you to buy, right? Simple. So what we're seeing today is Bitcoin is currently down by a couple of percent, not much, but altcoins are down further. But that indication means that dominance is starting to do something, right? A lot of altcoins are getting slaughtered, but some altcoins are actually doing very well. I know it's a balmy metric, this. So don't look at it too deeply, but essentially, when dominance is high, it's time to buy altcoins because they all are at lower value points, right? This is the BTC pair. I'm probably blowing your mind here. However, let's keep it simple. Let me show you the real life example. If you are buying when dominance is low, you are going to lose Satoshi value, which would indicate a value loss. So this example here is putting 1 Bitcoin into the market at low dominance, but the reason being is low USDT prices due to the FTX crash, okay? Split into 5 assets, you can see this very, very clearly, but the results are, these are down, right? This is obviously not real life prices, by the way. This is from about a month ago now, but it gives you a good example. So basically, when dominance is low and you buy an altcoins, you may well think you've got a good deal because the USD pairs are gone, and it's not bad to buy when this sort of thing happens. But actually, it would have been better if you waited. Let me explain. Moving on to the second bit. These are the examples of today's sort of prices. These are kind of, as I say, not up to date, but it's kind of giving you an example of how much it would have been in terms of the value that you would have got at the time versus the value in terms of, the dollars. It makes sense when you start thinking about it. It's pretty scary when you think about it. So your 1 BTC is now worth 66,000 at the time of me doing this example. It means you're actually down that much in Satoshi value, which is pretty damn scary, right? So what does it mean by that? Basically, when the time that you bought, the value of this has dropped in Satoshis, meaning it would have been better if you waited for it to be high dominance and you would have got a much better deal and you actually would be up. I will show you the example in the next video of why you need to buy when the dominance is much higher, right? The element to this is simple. The prices matter massively in the BTC pair because altcoins get certain things called alt season. This website here gives you a massive factor in terms of what is performing better than Bitcoin or not as good versus Bitcoin, essentially, right? You can see this over the last 90 days, 50 tokens. Very, very simple. Obviously, these are overvalued. These are undervalued, right? Obviously, lower ones even better, indicate a bigger price drop, right? So to keep it very, very simple, when you start seeing some of your altcoins on the floor in the BTC pair and dominance is high, probably a good time to buy. Try and ignore, and I know it's pretty advanced for a lot of you, the USD prices, right? It does not matter what you buy in. You can buy in USD, you can buy in Bitcoin. What matters is when you sell. And we're going to talk about the selling part in a second, why it's better to buy when dominance is high and when to sell when dominance is much lower. So moving on, the time to buy is when dominance is high, right? The time to sell is when dominance is low. Let me show you an example. So this is example 2 that I used, okay? It's very, very simple. It is exactly the same as what I've used. I just used coins that worked better versus the first ones, right? Why? Because I want to show you a real life example. If you bought these assets when dominance is high, basically, yeah, you would get the same amount of obviously units for what you're buying. But actually, because dominance remained high and is high, it actually means that you're up because we've had a mini alt season within this time period. These results are not the same now. Obviously, the price has changed a little bit, but let's just give you an example. When we look at example 1 versus example 2, in example 1, you're down by nearly 48% in BTC value, right? Problem. Dominance in example 2 is at 40%. Example 1 is 40%. The cost of Bitcoin was higher in example 2 versus example 1. But you are not benefiting from the dominance change. When dominance rises, your altcoin Satoshi values of your portfolio tends to drop. So basically, buying Bitcoin at the lows in USD would have been beneficial when dominance is low. Basically, buy Bitcoin then. If the alpha was to come into this play, you need to be able to use that Bitcoin that you bought at the lows to rotate into altcoins when example 2 is happening. So basically, buy Bitcoin when dominance is low. Use that Bitcoin when dominance is high. That's the caveat to all of this to manage your portfolio. That would then give you better results. For example, example 1 here, you didn't buy your Bitcoin, but you bought altcoins. You're potentially down in terms of that much value. However, example 2, if you didn't do that and you did what you should be doing, buy Bitcoin at the lows, buy altcoins at the Satoshi level lows as well when dominance is high, you could actually be up a lot more Bitcoin, right? Which is the important factor. So keep it simple. And what I mean by that is every single altcoin that you've got matters. You will look at your portfolio, and we're going to go through portfolio tracking and stuff like that very, very soon. You will see you can toggle your portfolio in Bitcoin pair and obviously USD. It doesn't matter what you buy in. The date of which you buy is important. If you bought Solana at a certain date when dominance is high or low, you'll be able to see in the Satoshi pairs what's happening, mostly for that unit, which is awesome. So this is the trick. Buy Bitcoin or sell into Bitcoin via altcoins when dominance is low. So if you were entering the market around here and it melts, buy Bitcoin down here with your altcoins. You might have made some money. Likewise, right now, you might be riding this wave. You might be in altcoins. When this drops here, you need to start selling into Bitcoin and hold Bitcoin when dominance is low, because obviously altcoins have run. When dominance is high, you then move your Bitcoin back into altcoins. Hopefully that all makes sense.
So portfolio management, relatively straightforward. I'm not going to teach you how to suck eggs, but some people need a little bit of guidance because you go a bit crazy. If you're new to the space and you're on YouTube and you're on Twitter and all of a sudden you're just buying and buying and buying and you keep buying, you're going to start finding yourself into a bit of a mess. So there's a few things I will be saying in this one. There'll be a few points I'll be saying as well. Again, it's up to you. Don't want to teach you what works for me. That might work differently for you. But at the same time, you'll get a gist of it. If you're good at managing stuff in your life, you'll probably be all right at this. If you're a bit chaotic in your life, you probably won't be, but you'll get used to it. So in the next video, we're going to talk about where you can manage it. There's a few different tools you can use on your phone. There's a few different methods online as well where you can keep a portfolio, but you need to keep on top of it. It is required that you manage it. And I know that sounds really obvious, but it really is, because you only have 0 to 100% in terms of risk. We're talking about the capital that goes in. So when you are inputting orders, when you're putting money into places, you're going to find something very common, and it is how much you're putting in. There'll be stuff that you like more than others, and sometimes you may go a little bit heavier when maybe you shouldn't. It's all about risk, right? Essentially to make money in the market, you've got to have a degree of risk appetite and grabbing the bull by the horns and going for it. But if you get it wrong, you can also lose a lot of money. So you need to be wary of it. The obvious here is money makes money, but that does not mean go all in on one. Please don't do that. That is a stupid thing. It's like when people say to me in the group chats on Discord and stuff like that, it's like, can I get a loan out just to buy some? No, don't do that neither, right? So be careful of risk management, because everything you do in terms of risk management will determine the result, which sounds dumb, but that's kind of true. When we talk about trading in other courses, when we talk about stuff on premium, often that's ignored is risk management, is your stop losses, is your capital at risk, the type of assets you're buying. If you're buying the wrong type of asset at the wrong time, you're not going to make any money. And that is a proven fact, even in the stock market. If you're buying tech stocks in a downturn, you're going to feel the losses more. If you're buying more common stocks that are paying out really good dividends that are recession proof, you're going to hold your wealth more. It's a factor of how that works. Profit taking is required no matter what you think. I will literally throw people out of windows if you are just I'm not going to sell. The ideology of a proven case study of Bitcoin is never going to work out all the time. A lot of people got lucky in the last bear market when they held on to the likes of Ethereum when it went down to, went down like 96%. People held on to that and it made money, but they didn't dollar cost average in. They're just like, oh, cool. To make money, you got to take profit. It is a taxable event. It is a pain in the bum, but it is a factor of it. If you are going to pay attention to low prices and not take profit when it's high and get your reward, that's why management is required. You should be able to manage that. You must keep a track of this, keep it up to date, and understand why, because that word tax as well is going to be a proven factor in the future. And the obvious here, set up a plan to ensure best results. If you are buying in the bear market and if you are selling in the bull market, there's a plan for both ways. Where you're going to take your profit, where you're going to take some money off the table, when are you going to buy, how long are you going to buy for. We will talk about that in a second because we need to go on to it. It's obvious. You've got a time frame. How long do you want to buy for? Bear markets tend to last over a year and a half. You've got time. You've got time to just soak up the orders. Don't just wait. Just put some money aside, which is important because how much are you willing to risk? Percentage risk, understandably, is how much money are you going to put on the table from your income. You got to have an emergency fund. You got to have all your bills paid. What's left at the end of it? What about Christmas? What about birthdays? What about social life? You've got to think of this as a plan as well. Buying. What are you buying? How much are you buying? What type of assets are you buying? All that kind of good stuff, right? When to sell. Or more to the point, if you're dollar cost averaging, when to stop buying and when to then look to sell. You got to have a plan for this. You don't want to be just randomly just doing it. If you have bought a certain asset at a certain price and you're thinking, you know what, if it goes to that price, I'm going to sell 10%. It's a part of the plan. It makes life so much easier when you commit to that. It removes the emotion. Then diversification. So if you've made money in the crypto market, or if you've made money in the stock market, whatever it is, and you want to diversify elsewhere and put money elsewhere into maybe dividend stocks, or maybe into index funds, maybe into property, more into crypto, all kinds of stuff you can do. Repeat. That's it. Straightforward, I know. So you got a time frame. How much are you putting in? When are you buying for, and how long are you buying for, essentially, and when you're going to look to sell. When you're selling, you've got profit to then diversify, right? Simple. Allocations of percentages, which is hugely important and often overlooked, because more in the higher cap proven assets is better. The likes of Bitcoin, the likes of Ethereum, because they will hopefully, with more probability, everything's, nothing's a given in investing, but the probability is they're going to probably survive versus buying something that's brand new, that has got no use case, unproven, never been in a bear market before, no revenue mechanism. You don't really want to put much money in there. Use profit only for those types of coins. So if they're a brand new release, if they're a bit sketchy, use profit. So if you bought Ethereum really low and you got a little bit of profit, take a little bit off that and put it in there. Simple, risk-free. Don't have too many of the same type of coin, i.e. going back to the research section, don't want to have like layer ones everywhere or layer zeros or just a type of coin that's all the same. If you got 3 coins exactly the same that do the exact same thing, there's kind of no point really. When percentage levels get too high, right, due to price increase, or they start moving up rapidly. I had this previously with a few of my assets where all of a sudden it was like 60% of my portfolio because the market just went with it and it went crazy and other ones didn't go with it. Take profit, because you don't want to be too exposed to that. If your portfolio is literally 70% of one asset because of a huge price increase, just take profit and diversify it into other assets that have not quite pumped, or just literally put it elsewhere. Ensure when you are doing this, please keep a track of it, because you need to ensure it's done correctly. You don't want to be logging onto an exchange or logging into your wallet and you're thinking you got more than you've not. And you're like, oh, where did that go? Oh no. God, I forgot about that. Or you've not kept it up to date, and then all of a sudden you're like, oh, amazing, I got extra money, and then all of a sudden you realize, oh, I sold it. Oh no. You don't want to be that problem. Don't have too many coins. Kind of obvious, but cryptocurrency moves fast. I often opt for roughly around 7 altcoins plus some core holds, so I can keep an eye on it. Also, if you're staking and you're doing passive income stuff, you want to be able to keep on track of it. You want to be able to keep an eye on it as well from a distance to make sure that the validators are paying out. All that really does make a big difference. So we're going to talk about the accumulation of units and why it's so important that you get this narrative in your head. A lot of people worry about the price in dollars when you should be worrying sometimes about how many units you've got. You've got to look at how much units you've got and how much you're accumulating, and obviously when and what you're buying. So going back a little bit in terms of buying solid assets that have been around for a while that you feel have got a much higher chance of survival versus the obvious ones that are a bit dud. What people do is they look at the dollar value of it and they look at how much they've got versus what it could be potentially, but also not doing enough to make more units, i.e. buying at the lows. Buying low, selling high, then redistributing it back into the market as well, or just staking. Simple lines of staking and utilizing what's on offer in crypto, on-chain native staking, which could make you up to 20% in terms of interest based off the fact of, the staking mechanism and the validator approach. So when we talk about the likes of Polkadot, right? And we talk about staking and stuff like that, this is currently about 15-16% staking, which is pretty good. However, that being said, this has been at all-time high level of about $55. You can see here, there's a potential here that this could make you a 10x in terms of value if you buy right now. Obviously, probability-wise, it's possible, but is it unlikely? Yeah, you could say that as well. You just don't know. It's how long you can be in a project as well. Sometimes you'll find that you may hold a project for absolutely ages, accumulate it, and it will take off just as you get to the point of selling it, and that's where it hurts. Bear markets are very, very hard to kind of get a hold of, and you may well find that it could be crazy. Now, when we look at the fact of if you can buy now 1,000 Polkadot, that's good. But if you were buying 1,000 Polkadot back when it was all-time high levels of $55, you would have had to fork out a hell of a lot to get that much. For some people, that is unachievable. This is why you got to accumulate in these lows and then ride the price appreciation and potentially change your entire portfolio based off some really, really good decision making. So the one thing that I will say as well, a lot of people get bogged down with the USD price. The aim of the game is to get as many DOT units or as many Matic units or as many Cardano units as you can. It's the same with the stock market. You want to get as many shares as possible to increase the chance and the likelihood that you're going to get wealthy. That is the ultimate game. Whether that is through dividend stocks, through index funds, through however mechanism you want to create money, you want to distribute it into the market at the right times to get the best possible outcome. Without risk, there's no reward, right? If you are just looking at buying a little bit, there's no point, because there's so many different variables that will make this more a costly experience, because there is additional subscriptions, there is education to buy for. So you got to make sure you understand that. So try and get as many units as possible within the remit of the obvious risk management in your portfolio. So something that we have to be brutally honest about is taxes, for obvious reasons. Now, if you are in this market to make money, you have to pay taxes. Unfortunately, that is the game that you're playing. Whether you're investing in the stock market, whether you're investing in, I don't know, whatever, trading, crypto, property, etc., right? Becomes a part of life. Now, I get the ick when people moan about it. You lay in your bed, you make it. You sit in it, do whatever, right? You have to have some sort of idea. Now, every country is different. So my stance is, I'm not a financial expert. I am not a profession in taxes. But what I will do is I will recommend you a website that will give you a report. This report can then be bought, printed out, given to an accountant. I would always recommend going to an accountant if you don't know what you're doing. Personally, I do a self-assessment, so I understand the process of what I'm doing. It's very, very simple when I have said report. What this does is it works with all the, the government kind of situation in terms of rulings of taxes. And essentially what you do is you sync up your wallets and it'll work it out for you. And you can see here on the images here, there's like little videos you can watch on here if you wanted to do so. You get a rough idea for free, but you do need to download or print off and buy the tax documents. Now, depending on how many transactions you do will depend on how much you want to kind of pay in terms of that. If you press on here for accountants, essentially you can have them to hook up as well into your account as well, which is really, really good for obvious reasons. Let's be honest here. If you can give them, so if you're in business like me, you know that if you're in like an accountancy firm, you can get access to people's accounts via the online stuff, and you can do that the same here as well if you so need to. In terms of integrations, it has most things. There's a few that aren't on here, but they are getting built. There is a public roadmap, but essentially if you have the wallets and the exchanges all hooked up, you can get a lot of information literally at a fingertip, which is great. Now again, we're talking about portfolio tracking here. If you want a free tracker, you can crack on and just have your portfolio in here and it tracks for you, which is quite nice in real time, which is pretty awesome for the most part, apart from the odd ones which you got to do export of CVS files or whatever it's called. Anyways, regardless, right? If you're unsure of what your country policy is, go to the bottom and go down to, bear with me, let me just make sure I get this right. If you go to the tax report section, I believe, there you go, you can find out all the different countries that they actually support. Now, if you're from the UK, you can click on it and it'll give you an idea of what's happening. So obviously filing it in the UK, how it kind of works as well, reading the guide, there's guides for it. But there's so much out here on this website that does make it easy if you're from the United States of America, how to do this, how to read the guide. Now, if you go to the guide section, there's a document that gives you all the information that you need to know about all the different tax rulings, all that kind of information, right? So it makes sense to have an accountant, but at the same time, it can help you as well if you know the rules. Reason being, you can decide the profit taking. So remember this, you are in charge of your own destiny. If you're taking lots and lots of profit, cool, you're going to pay more taxes. If you're not, you won't be, for obvious reasons, right? Because you need to make that unrealized to realized profit kind of gain to then therefore declare taxes. So, as I say, I am not an expert in this. This is a fantastic tool, and you can see all the information that it gives you. There's so much information on this website. There is a link below that will help you, so make sure you use it.
Hope you enjoy. Please get ready for the technical analysis video, which is a bit more depth to it. Obviously, this one's just basic about investing and how to kind of manage yourself and not blow yourself up essentially. But the technical analysis, when you mix it with this, it makes it a lot easier, certainly for dollar cost averaging and finding levels of exits as well. And if you want to trade, you can trade, and it makes it much, much easier if you have that knowledge. Technical analysis, in my opinion, is absolutely unbelievable because it is a skill for life. You can do so much more with that.